Okay, good morning, everyone, and welcome to this morning's Coffee Microcaps Technology Conference. And for anybody who hasn't joined one of our previous events, the Coffee Microcaps morning meeting, or a few other industry-specific events that we have run, you're very welcome. My name is Mark Kroell, and I'm the founder of Coffee Microcaps. I'm just going to quickly run through some housekeeping slides, and then we're going to get straight into it with our first presenter this morning. First of all, I'd like to give a shout out to DEM Asset Management, our sponsor for all our virtual events here at Coffee Microcaps. If you are looking for an active small and microcap fund manager, please do check out their website, or indeed reach out to Stephen or Michael for the relevant PDS for their funds. I'd also like to thank RAS Group, who are our research partner and sponsor on this event, and who have published on their LinkedIn feed, if you want to take a look, a one-page research note on every one of the companies that are presenting over the next 2 days. Quick compliance and disclaimer slide. The companies presenting this morning follow the same criteria we have at the morning meetings: capped under 300 million in revenue and cash, and approaching cash flow break even, or indeed are already profitable, generally from outside the resources and biotech sectors, so what I call industrial microcaps. Structure of the webinar: we've got 6 companies just presenting this morning over the next 3 hours or so. Each company is a 30-minute slot, which we're going to break down into a 20-minute prezzo and 10 minutes of Q&A. If you do have any questions for any of our presenters, please type them in the Q&A box rather than the chat function. It just makes it easier for me to moderate to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel. And that'll be up on Thursday. And tomorrow's event, where we have another 6 companies, will also be up on the channel on Thursday. You can follow us on all the usual social media platforms: Twitter, YouTube for the recording of this webinar. And as I said, we've got tomorrow's event going up there, and there's a host of microcap company presentations up there, well over 100 at this stage. You can get us on LinkedIn, and I also write a free monthly newsletter that you can get on the Substack platform. Just search for Coffee Microcaps. Our first presenter this morning, who I'm going to hand over to shortly, is Nic Pollack from K2fly. Then we have Rod Bishop from Jayride is going to be our second presenter. Then we're going to have Andreas Kroell from De.mem. Then we've got Christopher Clark joining us from Adelaide from Delta Drone. Then we're going to have Janie Conyngham from Bridge SaaS, a new IPO just recently listed. And then Sharif El-Ansari from Dropsuite is going to be joining us. So without further ado, I'm going to stop sharing my screen and hand you over to Nic. Nic, if you want to start sharing your screen, I'll let you know when I can see. Yeah, I can see the cover slide of your presentation now, Nic. You're good to go.
Thank you very much, and thank you everybody for your precious time today to listen to the K2fly story. I'm very pleased to bring it to you with lots of exciting news ahead and development so far. I'm just going to put that up there for a minute. What we're going to do in the time available to us today: quick overview of K2fly. What are the industry drivers that are driving the rapid uptake for K2fly's solutions in the market? In the global, particularly in the global resources market. Quick overview of results from Q1, and then we'll probably jump to questions after that in terms of the time available to us. I just want to sort of go off script quickly here and just give you an update that last week K2fly was attending IMARC, which is Australia's biggest mining conference, and it's actually not just an Australian mining conference, it's a very significant conference in the global mining agenda. Front and center of that conference in terms of thematics was environmental, social, and governance, which is a really core part of what K2fly are about. Of course, we're an ASX listed company. We focus on enterprise software for the resources industry, particularly at the moment, and delivering solutions in and around environmental, social, and governance. We are a very purpose-driven company. A lot of people are joining K2fly that have worked in the mining industry for some time. We believe that all resources are precious and that they should be adequate or well looked after in the best interests of the community at large, shareholders and all stakeholders. And our job is to work with the mining industry, not against the mining industry, but to work collaboratively with the mining industry to help deliver more transparency into the industry, as well as a more sustainable outcome as we transition to a net zero basis. So that's a lot about us and why we are, but it was in terms of thematic at the moment, this thematic is obviously prevailing all over the world. You know, you're probably turning on the news and looking at COP, the latest COP conference in Egypt. But in every industry, this is a key issue right now, and resources play a major part in that. In that regard, I'm very pleased to just give you a quick update on or overview of K2fly. And, you know, in that respect, if we are talking about the role of the mining industry in transitioning, and the organisations that we are working with are the very biggest and most global out there. So we are a company that's very much defined by our solutions, which are a selection of which are running down the bottom of the slide you're looking at now, but also by the scale and scope of the organisations that we work very closely with. Our market at the moment is very much focused in and around the top 50 mining companies in the world, and we are working our way through those organisations rapidly with various solutions. We are an Australian-based company, but we also have 40% of our revenues coming from outside of Australia, 20% from the Americas, and 20% from Europe, Middle East, and Africa. So a nice spread, but also demonstrates the global nature of our business and the global view that our customers are taking on this. Most of this information is readily available to all investors, but the part I want to focus on today is really the shareholder distribution. We have very strong support from the institutions. 3 institutions, Tribeca, First Sentient, and Regal, take up 50% of the share register. We have board and management at about 8 and a bit %. And then recently, in this second half of this year, we took on a strategic investment from Maptech. Maptech are the biggest private mining software business in the world, Australian-based, 40 years old, very well-established business, recognised the value of what K2fly was bringing to the industry that they play in. They understand very well, huge validation for what we're doing, and they recognise that, you know, it would be difficult for them to enter the solutions that we provide because it takes time and money, and saw a way to address those solutions collectively by investing in K2fly. To that extent, we've had some change in the board recently. Most of the board have been on the board for about 5 years. So that investment sort of kicked off some renewal, if you like. So Peter Johnson, who's the chairman of Maptech, joined the K2fly board when that investment was undertaken. Very welcome because of Peter's lifelong involvement in the mining software business, and Australia is well known for our expertise in mining technology. So about 60% of mining technology in the world comes out of Australia. So we play in that space. Surprisingly few mining technology businesses on the ASX, which always sort of staggers me a little bit. So if you believe in Australian mining and you believe in selling shovels to miners so you don't have to pick the winners, then these sorts of investments are a very good one in the long term. So great to have Peter on board. We are also welcoming Pauline Vamos, who has joined the board in October, and Pauline will be becoming chairman or chair at the AGM at the end of November. Thank you very much to Jenny Kutry and James Deacon, who'll be stepping aside. They've provided tremendous service to K2fly over the last few years, and are moving on to bigger and brighter things. But we're in very safe hands with Pauline, who brings a lot of experience across a number of areas that relate to K2fly. Given that we are leaders in creating a space called resource governance, in the market. Pauline is an ex-ASIC senior lawyer. She has also chair of Governance Australia, and has also direct experience in running ESG business, an ESG business that consulted directly to the superannuation funds, which she was very closely involved with while she was CEO of ASFA. So that's a great additions to our board. Very strong executive team here with many years of experience in both technology and sustainability, and enterprise business and delivering enterprise solutions to major customers. So I'm very proud of that team indeed. So if I was just to switch to the issues that are present and foremost and upper mind in CEO and board minds in the mining industry, just looking across the risks for the mining industry as presented from Ernst & Young, KPMG and Deloitte. And you can see little K2fly monikers next to some of those, whereby we either play in solving some of those problems directly or indirectly. And I'll just touch on a couple of them if you like. I can't go through them all in the time available, but obviously environmental social governance is an area that we provide solutions, not across all ESG matters, I must stress, but a number of key ones, and particularly key ones in the resources industry. Environmental risks, including new regulations. K2fly's role in resource governance is to provide technology and solutions that support either regulation or global standards in and around operating and ESG. So we replace existing systems, often outdated in-house systems, with off-the-shelf systems, and we build those around regulations and or standards rather than inventing them ourselves, which is pretty important at the moment with so much changing in that world and so dramatically and quickly. Community relations and social license to operate is fundamental to everything we do. It's baked in. Everything we do has that social element to it, and basically supports our customers' ability to maintain their license to operate. From Deloitte's, embedding ESG into organisations is key. There's a lot of outdated applications out there that don't support the rolling up, management and disclosure of good ESG data. So that's something that we support, and we're also doing that at the operational level. So many things where our solutions play a key role in helping these organisations to do a better job of managing their information, managing their operations, and then disclosing that to the market. Which takes me onto this slide, which just sort of describes the journey of K2fly, if you like, in as much as basically, if you look at the left-hand side there, resource disclosure, moving across to the right, some of our solutions, not all of them. But in that respect, resource disclosure is one of our key central solutions that most of our customers use in the first instance. So they basically deliver their resources and reserves inventory information to the market via the stock, via their annual reports, and is managed by the regulator. So depending on what stock exchange they're managed by or they listed on. This is a highly regulated part of the mining industry. As you can imagine, people cannot see the resource, so therefore investors have to trust what the company is disclosing to them via those heavily structured reports. So our software supports that process up to the point and then up to the point of disclosure, which, as I said, goes into the annual reports and constitutes a fundamental part of valuation of that company. So in the ESG world, very big G. Land access is another key thing in terms of gaining license to operate, all the permitting required that a mining company requires in order to operate on land, including things like agreements with traditional owners, with pastoralists, with the government, tenements, etc., etc. Those two things constitute fundamentally a big part of the value of any mining company, in terms of if they don't have the access and they don't have the resource, they don't have a business. So that's historically the way these companies are valued. Increasingly, as we're seeing, and too often on the front page of the newspapers, other areas as they pertain to ESG are letting these companies down. We've seen some terrible things happen in terms of destruction of cultural heritage, more recently in the Pilbara of Western Australia, albeit it's been happening everywhere. tailings failures, particularly in Brazil, Brumadinho and Samarco in the last few years with tragic loss of life. And then, of course, on the upside, how do we close and rehabilitate these mines? So those things are evolving very, very rapidly. So versus the left-hand side, where there's the traditional value, these things contribute hugely to license to operate, social license to operate, so value creation, but also, if done poorly or they let themselves down, can result in significant destruction of value for that organisation. And we've seen the impacts that Rio Tinto have had after the Juukan Gorge disaster. We now work with Rio on heritage. Since then, we work with Rio on the ground disturbance, which those two things go together very importantly. The same with BHP. We work with companies globally on tailings and rehab. So we are hitting these things that are very, very key to these organisations operating and maintaining their license to operate and maintaining their value. As I said, we build two standards. So on the left-hand side, there, the resource disclosure side of things, we support all the global reporting and disclosure standards under the CRISCO umbrella. So we build to that, and some of our customers are actually multi-listed, so they have to report through a number of different means, if you like. Increasingly lately, we're seeing lots of regulation coming in from ASIC, from the SEC, and the European countries on greenwashing. So a lot of what we do is providing foundational operational data that can be rolled up and then disclosed in ESG or sustainability reports with confidence that's auditable and disclosable, and prevents those organisations being accused of any sort of greenwashing activities, because they have the governance in and around the data that they're providing to the market and disclosing to their stakeholders. We also work with organisations like the ICMM to support ICMM, a peak body in the mining industry, driving standards, and we build, where we possibly can, we build to support the standards that those organisations put out there. So what makes our solutions invaluable to our clients is that protection of license to operate, operationalising ESG so that they have better operational systems. We're often replacing outdated systems that are in-house built with off-the-shelf, providing those operational systems to those organisations so they have a standard approach to this, but also driving better data in order to disclose and talk to the market. Reduce that potential for greenwashing. We bring deep industry knowledge. That's a core part and differentiator for this business. The mining knowledge we build and the way we interact with those clients on regular forums, and adherence to regulatory and industry standards. So that's what's driving a rapid uptake in our solutions with these global miners. The way we do that in terms of this definition of resource governance, we have natural resource governance, which is sort of land management is another way of looking at that, heritage, land access, disturbance, tailings and rehab, mineral resource governance, which is resource disclosure to the market, model manager and reconciliation of those results, and then a technical assurance that sits underneath that. So a range of solutions that we're build, buy and partner to build out this suite, if you like. Just quickly on our Q1 results, our key metrics that we look at, annual recurring revenue and total contract value. Annual recurring revenue continued to grow in Q1. Basically, our current number is 6.5 million. Last year, annual recurring revenue grew at a very healthy 76%, and our total contract value, which is a function of annual recurring revenue via times the terms of our contracts plus the implementation, sits at about $19 million. And last year that grew at a very healthy 80%. So those two key metrics are really driving strongly. In terms of key contracts in Q1, Fortescue has been a long-term customer of K2fly, continues to give us new purchase orders, another new purchase order for $1.2 million for the next 6 months on one of the solutions that we provide, and really excited about the Imerys contract, which is a new contract with Imerys, is a French multinational industrial minerals company. They operate in over 200 sites globally. They are a very large producer of industrial minerals, and we're just starting a project with them, which should last some time. And the initial contract was for the first 15 sites, but we would look to be rolling that out across all 200 over the next few years. I've talked about the executive changes at the board level, and they're also really excited that our new governance platform, which we've been investing in heavily, will be released this quarter. As I said, our results continue to head in the right direction. From an investments perspective, we are delivering on our continued record of growth and track record in growing our business in both ARR and TCV. Really proud that a couple of things here. Our average deal size has grown almost fivefold on the right-hand side there. So that $340,000, nearly $350,000 number is a fivefold increase on the average from the previous years, if you like. That's basically showing that the value of our solutions to the industry is now being recognised on a more broad basis, and that's coming through in just the license alone. Our net retention rate sits at 126%. That's right up there in terms of industry benchmarks and standards. I think top performers at the very top are about 132 to 134. So K2fly is right in the right spot for that. What that effectively means is that we have this base of customers and revenue now, whereby if we don't sign any new customers, which is not our intention, we will continue to sign new customers, we are driving another 26% of revenue each year out of the existing base through upsell and cross-sell on our annual recurring revenue. So in summary, strong ARR and TCV growth, our land and expand strategy within our major clients is working really well with that net retention rate. But we continue to sign new big names, and you'll see more of that going forward, and then new solutions within those big names as well. So a really strong pipeline of opportunities. We're not immune to the fact that at the moment, cash flow positivity is very important for investors, along with growth. So before it was all about growth, and now it's about getting to break even. And we are very much on that path. Our Q4 was a very strong cash flow positive quarter, which meant that our year was about sub $1 million in terms of cash flow negative. So I think a lot of our investors now can see a very clear line between where we are today in terms of cash flow negativity, but also the growth in the business, and also producing quarters that are cash flow positive in order to get us there from an annual perspective in the not too distant future. So in that respect, there's highlights in terms of this investment that I was talking about, record growth in these key metrics, high caliber team, the industry dynamics and tailwinds around ESG, and how the resources industry in particular is looking to secure and really long, sticky recurring revenue. So this enterprise solutions that we put into these organizations last for 10 plus years, even though the contracts might be 3 to 5, history shows us that this software stays in these businesses for a very long time. And at that point, I'll wrap up and go to questions. Thanks, Mark.
Thanks, Nic. Yeah, we've got a couple through already. The first one, does your target market only include the large miners? What about the mid and small tier miners, or do the unit economics make it not worthwhile chasing those sales? So maybe, customer segmentation.
Yeah, so there's roughly 3,500 mining companies in the world. 3,000 of those would be considered juniors. So our focus is really that top 500 operators and producers. So I think the question is, the way they phrase it is good, is that the unit economics for us now to chase those junior miners is not we can't supply them. We don't have the scale to do that. However, that is definitely part of our plan, is to bring our solutions from the top down to the bottom, which is, I'd rather start at the top and work down for obvious reasons. And also with our investment in our technology. So I talked about the release of our new resource governance platform, which is basically a complete rebuild, ground up, cloud first offering, which will make it much faster, cheaper, and easier for us and our smaller clients to get into these solutions. So we're bringing technology to those companies increasingly in order to be able to address the smaller companies.
And then a question on who are the typical competitors you come up against, and how does your pricing compare versus them?
Yeah, I hate to sound trite because everybody says they have no competitors. In a number of those solution areas, we have no commercial off-the-shelf competition, and that's basically for a number of reasons. Myself and my colleagues have been in this mining software business for a long time. We know what's out there, what's not. Most of what we're replacing in these major minings is almost always in-house software technology. So we're replacing that with off-the-shelf software. So, for instance, a good example of that would be the projects that we've announced at Rio Tinto and BHP around ground disturbance and heritage are both basically replacing in-house software, and with the challenges that are facing these organisations today in and around increased scrutiny on those areas of operation. They're looking for software vendors like K2fly to provide that. So we don't have a straight up competition. Basically, it's sort of replacing old.
Okay, and then a question from me. You've got 60% of your revenue coming from the Australian market currently. How much growth is still left for K2fly in the Australian market, or is it, in terms of growth potential, it's more mature, or is there just more solutions you can sell to the likes of BHP or Fortescue that they're not taking currently?
Yeah, so I'm going to answer the question with your last statement there, Mark. I mean, basically, we have a great list of clients. I'm assuming you can see that that slide there. This is just some of our clients, not all of them. And what I'd ask you to do is focus on the white space there. So, we've just announced BHP, but we're working in one solution area in one area of operation. A lot of our clients in that resource reporting area basically have to buy, because of the nature of the solution being a disclosure in the annual report. It's corporate, so it's every site. So that gets us into that corporate office. But there's a hell of a lot of white space in that top 50, 100, 500 mining companies for us to work through. So there's a long way to go. So when you say the Australian mining companies, I mean, I would ask, is Rio Tinto an Australian mining company or an international mining company? It's you can see the progress we've made with them in terms of starting with one solution in resource reporting and now working on 5, but only not in all areas. So there's a long way for us to go in terms of pipeline of work here.
Okay, and then just on the MapTech strategic investment, have there been any commercial benefits of having them on board as a shareholder? Working to come up with a maybe combined solution to service clients that they have that you're not involved with, but they can bring you in as a partner and offer something that they can't. Or what has been the experience so far since they've come on board?
Yeah, short answer, absolutely. So the new resource governance platform and our resource disclosure new version of that coming out this quarter will be integrated with MapTech Vulcan. So MapTech Vulcan is one of the most successful mine planning software in the world. So it has a huge customer base, and we have got a lot of inbound inquiry on the back of that investment, also on the back of that, the announcement of that integration. So again, we're not competing with MapTech there. We're very adjacent and very compatible. And I also stress other competitors of MapTech, which we're also working with as well, with MapTech's agreement to bring them into that, be able to integrate to our solutions as well. So yes, very much indeed. The good news is with MapTech is we work collaboratively. We don't have to have any sort of margin provision to them, because it's a collaboration rather than a reseller agreement.
Okay, great. Nic, we're just about up on time, and I don't want to try and squeeze in another question here in this last minute, because it's going to put you under pressure to give an answer in the time available. So I think we'll leave it there. Thank you very much for joining us this morning. And yeah, if anybody wants to contact Nic or go on the IR distribution list, his email address is up on the screen there. So Nic, thank you very much. And I do know we have our second presenter, Rod Bishop from Jayride, standing by. So Nic, if you could just stop sharing your screen. And
thanks, Mark, and thanks for everybody for listening to our story, and look forward to hearing from you. Thank you.
Perfect. And then Rod, if you want to start sharing your screen, I'll let you know when it's coming up. Yeah, it's coming through now. Yeah, I can see the cover slide of your presentation now, Rod.
Thanks, Mark. Good morning, everyone. My name is Rod Bishop, co-founder and managing director of Jayride. Today, we'll cover who Jayride is in just 1 minute, because I believe a lot of people on this call may be familiar with who we are, and then we'll get stuck into what the latest results are showing us and what is the outlook both for Jayride, but also for the global travel industry as we continue to unpack that, once in a generation travel recovery. So Jayride is a travel technology company at an early stage in a long-term growth trajectory. In short, we help travelers to find and book their rides around the world. So by rides, I mean shared airport shuttles, private cars, coach lines, ride-hailing companies, brands you know like Lyft, Cabify, brands you don't like a great local operator that can take you around the Canary Islands or Santorini, Malta. We package these up and we deliver them to travelers at jayride.com, where you can book B2C, or through the travel industry, where we provide travel brands like Booking.com, Expedia, Cartrawler, with a turnkey solution that allows them to plug and play the entire global rides industry. This has been a hard problem for the travel industry to solve because rides are very fragmented. There's many, many local suppliers, and you need to have a large amount of aggregation in order to provide a compelling global offering. If you're Booking.com, for example, with hotels in every country on earth, you need much more coverage in terms of rides availability than any one aggregator has ever been able to provide you before. And this is what Jayride does. We allow Booking.com and others to simply plug and play and turnkey the global rides industry. You can see a graph on the screen there. This shows our revenues, 6 years of 98% CAGR to December 2019. And then we know what happened in March of 2020, the onset of the pandemic, and Jayride did lose at that point 95% of its revenues, but we got through it. We got through on cost savings and crucially retained all of the core IP of the company so that we're ready here and now to capture and outperform the travel recovery as it comes through. In February, we were trading more profitably than we had ever been pre-pandemic. Throughout the pandemic, we'd focused on margin. Before the pandemic, we weren't, to the extent of what's possible in terms of scale. It looked like we needed to raise our ambitions beyond simple recovery. And so we outlined at the time, people called bold major milestones beyond recovery, focusing on things like running a cash flow profitable operating company, noting that we were still investing for growth, just keeping an eye on the fundamental operations and making sure it was cash generative. Secondly, running a very strong set of unit economics, much better than we had done pre-pandemic. And then thirdly, taking those unit economics to a level of scale. And since February, we've been dusting off on those milestones, hitting certain cash flow and EBITDA profitability milestones that we targeted, hitting the contribution profit margin milestone that we targeted. And when we look ahead, the two major milestones that are standing right in front of us are $10 per trip. That's the revenue that Jayride will make at 1 million passenger trips booked per year. So 1 million trips a year, $10 each. This is our next set of milestones to crack with regards to scaling and regards to profitability of those trips. Paying attention then to how the trips are growing, it's been an interesting story, as you can see on this graph, that navigation through the pandemic. There's a few things here which show where we've come from that will give you a really good idea of where we're going. And so I'm just going to spend a minute on here to point this out. So as I've mentioned, pre-pandemic, a very straightforward growth story here. You could expect growth every quarter from Jayride. And then obviously the pandemic came through. But what you'll notice comparing post-pandemic to pre-pandemic is that the mix in terms of geographies of where we're sourcing our revenue has substantially changed. And in particular, you'll note the ascendance over the European market. So to explain that, I've got to take you back in time a little bit. In 2018, when Jayride listed, we used our IPO money to roll out around the world. We'd been operating in 5 countries. Large partners like Booking.com had told us, well, that's great, but we operate globally. If we're going to have a ride solution, it needs to have a global set of coverage. You need to go wider, Jayride, if you're going to be a good solution for us. And so that's what we did. We used 2018's funding in 2019 to roll out our technology solution to cover not just 5 countries, but over 100, 3,700 transport companies that served over 1,600 airports. And that represented 95% of world airport passenger movement. So 95% of where travelers actually go on Earth, we were covering by the start of 2020, at which point we all know what happened. And so what's interesting to note about this is that all of that IP, both in terms of the technology platform and also in terms of the supply coverage, and also all of those commercial relationships. So the Booking.coms, the travel partners that we signed on the back of that new supply base, all of that was retained throughout the pandemic. And around about May, we started to see what you can see here on the screen, growth in Europe to a multiple of pre-pandemic, not constrained at all by where we've been before. And that growth is on the basis of that retained IP, the work that was done in 2018, 2019, and into early 2020 to build our global supply base and roll that out through the travel industry. And that's an important point because what's happening now in Asia is potentially the same. So again, pre-pandemic, the rollout, the new countries that we offered was Europe and Asian destinations. Europe, as it reopened from the pandemic first, as travelers from England got traveling across mainland Europe in summer, multiple of pre-pandemic. And then you can see what's coming up in Asia. You've got Japan reopening, Hong Kong reopening, Taiwan reopening. Right now in latest trading, October, as I mentioned in our quarterly business review, is run rating above the prior quarter, which is rare for an October. October is usually neither summer in the Northern Hemisphere nor in the Southern Hemisphere. So ordinarily October would be seasonally low. Instead, it is our highest run rate month. And the thing that's driving that again is Asian reopening. A nice kind of simple example of that, Australian tourists to Denpasar Airport in Bali is now Jayride's top IATA globally. And so this was never the case before. And in current weeks, Asia is significantly above where it's ever been before. So this growth in terms of passenger trips and where it takes us, we think, is to a continued outperformance of the travel recovery. We show trips growing. I can also show those trips expressed as market share. Green line in the top graph showing Jayride's passenger trips, the blue-gray line in the top graph showing the overall airport passenger trips traveled. That's every individual seat sold on an airplane. The data there is from OAG, which is a credible global source of airline data. And you can see that Jayride has outperformed the travel recovery by 238% over the last 24 months. So we have a travel recovery macro, but we're also winning market share. We're outperforming that travel recovery, and it looks set to continue, especially considering what we just saw in Europe and what we feel is set to happen in Asia. Trips are the major driver of revenue, but when we encourage everyone to look at Jayride's potential, we look at 4 numbers, and I encourage everyone to model the company this way because this is how we think about it internally. Jayride's business is successful if we're growing passenger trips, if we're growing net revenue per trip, if we're maintaining high margins on that net revenue, that's the contribution margin there expressed after all variable costs, including, for example, customer service. And if we grow those things whilst keeping operating and corporate costs flat. Those operating and corporate costs, they exclude discretionary growth investments. I want to be just very clear about that. We are also investing for scale at the moment. We have the balance sheet to do so. But as we do so, we want to make sure that that operating company is becoming increasingly more profitable, increasingly cash positive over time. And you can get to that by looking at these 4 graphs. And so passenger trips booked, which has grown 115% versus PCP, net revenue per trip has also significantly expanded. And it's on the basis of simple things like refund rates coming under control as the pandemic ebbs, but also our expanded traveler offer and the way that we're bringing new services to market that I'll talk about shortly. That also has expanded such that the net revenue per trip has grown on top of the trips, and net revenues quarter versus prior corresponding period was up actually 157%. So a very significant growth rate there. Contribution margin has remained at that peak level now for 3 consecutive quarters. We quite like it how it is. And that also is now an increase over PCP. So contribution profits grew 250% versus PCP. I think you can see in these numbers the kind of outperformance that we're generating here over a kind of a more standard, shall we say, travel recovery. And all of this while operating and corporate costs have remained roughly stable. And so you get a real feel here for the operating leverage in the business. When we look forward and we want to see, how this increased performance will generate cash flows, it's worth noting that we have actually reached a really interesting inflection point. The company is operating with cash flow positive after standstill operating costs now for 2 quarters. So this is not after our discretionary growth investments. Again, I'm happy to cover what's in what bucket, but just considering that fundamental performance of the basic operating company, that now generates cash surplus to fund those growth investments, at least in part, for over 6 months now. And that is on the basis of cash receipts from customers, which grew 686% in Q1 versus prior period. So again, a very significant outperformance of the travel recovery there. So as we grow from here towards those next 2 milestones, it's important to kind of think about what we're going to do with that surplus. So those 2 milestones, again, that we're heading for, 1 million passenger trips booked a year at $10 each. That's sufficient to create a fully cash positive company. So the cash receipts and the surplus after the operating business will be enough to fund our growth investment the way that it's currently sized. And that's just, we like to say, the first of 2 growth horizons, because when we think about this opportunity, to be the world leader in rides for travelers, that is a large opportunity that extends in terms of growth for many years. We outline the vision and we say our vision as a company is to deliver door-to-door rides to suit every traveler's needs in every country from anywhere to anywhere. Today Jayride has limits, for example, right? We are limited only to airport rides. We're limited only to English language. There's many very obvious things that travelers need that our platform today doesn't yet do. And so as we grow through kind of Horizon 1 and become that cash positive growth company, we lay ourselves up to Horizon 2, where we just get to keep growing and self-funding our growth for the long term. So at Horizon 1, around that 1 million trips mark, we've been doing well in Europe, but only in English language. We get to expand, for example, with regionalization into non-English languages across Europe, for example, Spanish. We also get to target better Asian destination reopenings, still, considering those only from an Australian source market perspective. When you take that to its natural extent at 10 million trips a year, well, at that point, you're considering, full multilingual platform, just like every other online travel agency. You're considering full global source markets. So being able to source travelers from travel brands and B2C and not just English language markets, but everywhere on earth. When you think about the traveler's problem and the fact that we're serving that problem today only at airports, we needn't stay there. And at 1 million trips mark, give or take, we'll be starting to cut turf on non-airport rides. And that might be, for example, a focus on European rail stations, cruise ship terminals, river cruises, these sorts of things. But by 10 million trips, you'll be able to do anywhere to anywhere. And so not just an airport ride, if you as a traveler need to get, together with all of your conference people from, the conference that you're at to some sort of hospitality venue or whatever at the end of the day, we'll be able to provide that sort of service. Remember, the buyers, not just B2C here, considering trade buyers too, this sort of ride will be significantly in demand. And then the very last segment would be to think about, again, right now, pre-booking around about the same time that a person books the flight. But plenty of travel needs to be changed at last minute. And at the moment, the best we can do often is cancel and say sorry. We should be able to address those last minute concerns, even if your itineraries are changing in destination, even if you want to add additional trips when you're in destination. And so those in-destination rides and allowing Booking.com and Expedia as well, especially to serve those, it will increase the number of rides that are able to be taken by a traveler when they're in destination, from just the airport transfer to many more. So you can see growth trajectory here for a very long time. Onwards and upwards, though, towards those growth horizons, it's important to get practical. And so for the final part of this talk, I would just speak kind of very practically through how we're getting to that growth horizon 1. The way that we always think about the business is in terms of growing both in terms of acquisition of new travelers, conversion of existing traveler quote volume, of which we have a very large amount from our travel brands, and then also retention of travelers, making sure they have a great experience, making sure they come back. In practice, that acquisition, conversion, and retention over the next period gets addressed by two major streams of work. First being the expansion of our global reach, for example, strategies for Asia and Europe, and second, through continued expansion of our traveler offer, making sure that we've got the things that travelers want to buy. So I'll cover those two things. That first one, which is about that global reach, I've mentioned Asia. This is about capturing those destination markets as they reopen. This is Australian travelers outbound to all the places that we like to travel. It's not been holiday season here. It's coming into one. Also, those destinations have been closed. Now they're opening. This is a really once in a generation market capture moment. And as I mentioned, success in Bali already, early signs of good traction in Japan, Hong Kong, Taiwan, and other destinations that are reopening give us a great deal of confidence in what's coming up there. Europe, slightly more midterm. I mentioned we've done very well across summer. We want to get ready for multilingual, at least in terms of one or more regionalization before next European summer. We're leaning hard at the moment into Spanish. We're starting with back-end solutions, for example, customer service team, transport contracting team. We'll deploy that support for that language across offline sales channels first, for example, phone sales, travel agents, before expanding that to the website. And once we've cracked the template for one regionalization, the opportunity to expand to many other source markets across Europe is kind of there for the taking. The supply is in place, the solution works, and it's just about increasing our TAM. A conservative estimate, I think, is it would be an 8-fold increase in our TAM in Europe if we support all of the major European languages. Lastly, then, North and South America, opportunity to do things there as well with Spanish language, but also just with travel brands and maturing our solution. It's a mature market there for us. In general, always in each of these instances, we're taking a lowest hanging fruit approach. There is just so much opportunity. So working in a disciplined way, always to find the growth that will come at the lowest cost. That's the first. The second being that expanded traveler offer. You can see net revenue per trip on a previous slide, and you might have noticed that it shot all the way up from $8 to $8.89. And I mentioned at the time that this was about expanding our offer. Pre-pandemic, Jayride only offered, and this is quite amusing in retrospect, economy class services. Jayride would be retailed on booking.com as economy sedan only. And, just think of the gap there that creates. There are buyers for business and luxury class services. There are buyers for, SUVs right the way through luxury limousines, stretch limos, people movers, the works. So over the course of FY22 and there in June, July, we finally launched our expanded offer in vehicle types and service classes to sell those kind of premium goods, the larger vehicles, the better services that have the higher average order values. And then across kind of July through September, rolled those out through travel brands such that they were now retailing on booking.com and have been for just a couple of months now. That's what's driven that net revenue per trip increase. Also drives a conversion rate increase because travelers actually can buy the things they want. So there's plenty more legs here in terms of really fleshing out our content coverage into all those destinations, but also in terms of further expanding the offer. You can see here a roadmap for Growth Horizon 1 and 2. There's plenty more things that we can add here to increase net revenue per trip, increase conversion rates, really give travelers the things that they want. Important to point out, this is not guesswork. This is things that booking.com on account service calls directly asks us to give them. And so the channels are in place, the quote volume's in place, and it's just about making sure that we have the offer to suit. We categorize those as extras and ancillaries. That is, add a child seat, add a meet and greet, add an extra stop, add some sort of premium assurance product. Lots of things you can do to increase the cart size there. Non-airport destinations, as I mentioned, be it, for example, cruise ship terminal or river cruise or conference center, and then last minute. So reducing that booking in advance window down so that if people have last minute itinerary changes, as I'm sure everyone has had in the past, that those rides can be rebooked and suppliers can take care of the traveler. By Growth Horizon 2, moving still further onto that in-destination ride hail. And so just to conclude, this is, Jayride. We are, as I've said, a travel technology at an early stage in a long-term trajectory, but, crucially, this is a growth company that can make money and will do in the near term at $1 million at 1 million passenger trips booked a year and $10 per trip. We're building the global leader. This will be the first time a comprehensive solution has been provided to the travel industry in terms of their rides, and it works across both B2C and B2B. It's what we call a strategic asset. It's the kind of thing that Booking, Expedia and others need and aren't really going after to build themselves in the way that we are doing. The strategy is very clear. It focuses on just retention of travelers, conversion of existing quote demand, and acquisition of travelers through new channel partners and paths to market, primarily through those functional areas of just expanding the destinations we serve and expanding the content that we offer in those destinations. We're sitting here looking at a growth tailwind. You've got reopening still ahead, for example, in Asian destinations. We're winning market share beyond that. That is 238% gain in share over 24 months. And in general, there's a secular trend to book travel online. It's played out across all other verticals, flights and the like, and we see it playing out across rides too. Holistically, together with Booking.com and others, I see the travel industry cannibalizing the taxi rank in years to come. Why stand in the taxi rank? You can have the whole itinerary booked door to door. Thank you guys for listening to the talk today. That's all of the formal content, and I'm very happy now to answer any questions you have.
Thanks, Rod. I might just kick off the questions. If we just go back to Europe for a second and the huge growth you saw over there, summer season, I'm guessing another implication of the pandemic was a lot of vendors you would have lost, or a shortage of hire cars. I know I'm talking to people based back in Europe, was a big problem this summer season. So I just wanted to get a sense of, do you think you lost much volume purely because there was nothing on offer? So in other words, the car hire companies just simply didn't have cars, or there wasn't enough Uber drivers to match demand over that huge summer season that they did see in Europe.
It was interesting, wasn't it? June especially was a very chaotic time in Europe. In general, infrastructure in the travel industry couldn't keep up with demand. But I think that has both two edges to the sword, I guess, Mark, because you can see that we did very well across the period. I put some of it down to the secular trend to moving online has been accelerated by the onset of the pandemic. Nobody who's concerned about COVID really wants to stand on the crowded London tube or, in a crowded taxi rank. It's not, I mean, for the sake of spending a couple of bucks on getting a private ride service, it's a much more confident bet. You add also then, in general, supply chain disruption, rental car unavailability, a bit of chaos around whether or not your Uber driver or your Lyft driver is actually going to be available if you turn up to hail. Having a pre-booking of a ride is again, a very significant confidence booster for a traveler that's otherwise maybe a bit anxious, a bit cautious, given the environment. I see that really as like a conditioning moment. I think a lot of travelers have had an experience here where they had their entire itinerary door to door, and they've liked it, and they're coming back, and we can start to see that in retention numbers. So I actually see long term that the pandemic will have been a boon to the secular shift to online.
Okay, and then you talk about taking market share or growing market share in a lot of these markets post-pandemic. So maybe just give us an idea of the competitive landscape as it sits now. Who are your major competitors? What has happened to them over the pandemic? Who are they even still going? Did one or two of the pre-pandemic competitors fall by the wayside through COVID?
It's a very good question. I'll address it at the small online competitive segment first, but then also we'll talk about the overall market. With regards to online competitors, there's really only a handful of other assets in the space. In general, because Jayride works directly with the most suppliers, we tend to treat those other assets as partners as much as we treat them as competitors. So they will implement Jayride supply just like everyone else, and retail Jayride supply and take it to market. So this is not uncommon in the travel industry. It's a land of frenemies. Those who watch, for example, Booking and Expedia will note, although they compete together, they also work together more than half the time. So very common. However, what that did for us at the onset of the pandemic was not great because a lot of them fell over. We have, some of those frenemies who, potentially still owe us money, let's say. They were not able to pay transport companies at the onset of the pandemic. They still haven't. They were not able to pay traveller refunds at the onset of the pandemic, and they still haven't. This is not great for their long-term brand reputation, and it has resulted in them losing channel brands, travel brands that they would otherwise go to market with, but also losing suppliers who no longer want to serve them. And so it gives Jayride a bit of a competitive advantage there, that we're still able to access all the best supply. We're still able to retail through all of the best channels. The fact that we were able to, through the strength of our balance sheet and the fact that we're a listed company, be a stronger counterparty to the industry than anyone else is at least a part of that driver there, that 238% gain. But at the higher level, like I said, I believe we're still in the early innings of a secular trend to booking online. All travel is moving online. Flights move first, hotels second, rental cars third, transfers, tours and activities, these sorts of segments to me are next. When you are a traveler and you're standing in the taxi rank, you have a travel relationship with a travel brand that booked your flight, probably booked your hotel, and has actively left you standing there having a terrible experience while you wait 45 minutes to get picked up. The travel brand would have loved the incremental revenue, would have loved to retain you with the service. And the only reason they didn't is that in terms of legacy tech and the aggregation required, it's just historically been too hard. Given a very easy global turnkey solution for Booking.com and others to simply bundle the ride with the hotel purchase, every traveler would prefer that. Nobody really wants to get stuck waiting at an airport for a ride. And so we believe in general that the pandemic's been an accelerator to that overall macro trend. And we're looking forward to the next couple of years.
Okay, and then we got one just coming from the audience. Critical input to the business model is the driver in each geography, and drivers can be somewhat fickle. So what motivates drivers to contract with Jay, and in the process, risk opportunity, cost of a better short-term hire that might appear? So it's picking up somebody booked with Jayride versus somebody who wants to go to a hotel that's maybe the complete other side of town in a more lucrative job at the time being while they're waiting.
This anonymous attendee who's asked the question has a great knowledge of the travel industry. You're right. Ground transport as a segment has been historically renowned as being quite full of cowboys. In the same way that before Booking.com, boutique hotels were not held in as high regard as major hotel brands. What Booking.com did for those boutique hotels, though, was added as a third party a layer of trust and accountability with reviews that allowed a traveler to, even though they didn't know the brand they were staying with, get trust and conviction and read reviews they could use to make the right decision and have a good experience, even if they'd never seen the hotel label before. Jayride adds that same sort of trust and accountability to the travel industry. So we do it in all the same ways. This is about aggregating. This is about making sure the rates and service qualities are correctly listed. This is about selling it in the traveler's language, in the traveler's currency. They can know what they're getting. This is about holding the money, making sure that service happens well. If not, making sure that the traveler gets their refund. This is about making sure that the traveler can review every ride so that every transport company is only as good as their last service. And if they're not getting 5 stars, then no one's booking them. And so all of these things really add trust to the industry. And so then considering who's in the industry, although, the cowboys get a lot of attention, there are plenty of very high service quality firms that you otherwise just can't find. They're out there, but how do you tell them apart? And that's the thing that Jayride offers, the ability for, the travel brands, as much as the travelers, to know that they're getting a very high quality supply that, doesn't have a driver who's fickle, doesn't have a driver that's going to drop a booking to take a different fare. Because the moment that they do that, they lose their distribution. Very simple worked example just to conclude. Booking.com leans heavily on us for service. We lean heavily on a transport company for service. If a driver's going to, do as is described there, such that that transport company risks losing distribution through Booking.com as a result, we'll turn them off. No, they pay attention. There's enough buying power that we've got there now to make them sit up and want to provide really great service for Jayride customers. And so that, as we continue to scale, just becomes more and more powerful. That advantage becomes more and more entrenched for us.
And then just one quick one from me, Rod, on the new products. So you said, previously you were only offering, the economy sedan. Now it's everything to, stretch limos and all these ancillaries. Do all these ancillaries and the kind of more exclusive vehicles, do they also come with better margins, or is it, similar margins, but the actual dollar figure that drops to the bottom line is bigger purely because the price point is higher?
That's a good question. I'm going to be careful with the answer there. So the expanded vehicle types and service classes have much higher average order values, which manifests as good net revenue per trip for Jayride. When we mark up, we do so at a fixed percentage, and so larger carts are necessarily more money for us. When we get into the extras and ancillaries landscape, though, how much is a child seat really worth if you simply need it? I mean, you simply must have it. And so I think there's also potentially an opportunity to stretch our legs a little there, all of which will be very accretive to net revenue per trip and to revenue growth rate.
Okay. Thank you very much. We're bang on time here now. So thanks very much for joining us this morning. It was great to get the update now that the Q1 numbers are out. And if anybody's going to be traveling over this summer season, be sure and check out the Jayride offering wherever you're going.
Yeah, we'd love to see you all as customers. We do actually have a shareholder benefit scheme where you can get discounts on your rides. So feel free to email us about that if you're interested. And again, looking forward to that growth towards cash positive, 1 million trips at $10 each. We look forward to keeping the market up to date. Thank you.
Thanks, Rod. And if you could please stop sharing your screen. And Andreas from De.mem, I know, is waiting patiently for us in Melbourne. Andreas, I can see yours coming through now. If you just want to go to, there we go, full screen mode. Perfect.
Yeah, good morning, Mark. Good morning, everybody. So thanks very much, Mark, for the opportunity to present here at Coffee Microcaps. Well, I've been presenting a few times actually at your forum, Mark, over the last couple of years. So I would just want to start very briefly with a short summary of the key themes about my company, De.mem. And then really focus on those few recent events that we've reported to the ASX over the last few months, and where actually calendar year 2022 is tracking. So De.mem, well, we are in water treatment. De.mem stands for decentralized membranes. We deploy our solutions usually containerized, not necessarily in remote locations, but typically on the customer side next to the customer's factory. So with decentralized, we really mean that we go close to the water source, and we treat the water or wastewater well, in a very flexible way on site, basically next to the water source. So our business, it splits into 4 main segments, and this is important for our strategy, and I will come back to that a few times throughout my presentation. So basically our offering starts with the equipment, with the membrane systems. So that's basically the design, the manufacturing, the commissioning of these containerized, usually membrane-based, well, water treatment systems. This is more of a one-off projects type business, but it feeds very well into the other 3 segments, which are very important for our overall strategy, which define our margins. And those other 3, these are the recurring revenue segments. So this includes in particular our service offering, which is the build on operate plants, where we rent out the facility. The container actually stays on the De.mem balance sheet, stays under our ownership, but we rent out that facility and operate it on the client's behalf. Or where the client doesn't want to rent, we can also offer like an operations and maintenance O&M type arrangement, which is also usually quite a long contract over a number of years. The recurring revenue segments, that includes also our specialty chemicals. So every membrane-based water treatment plant will need some sort of chemical, like anti-scalants, membrane cleaners for the ongoing operations. We manufacture and sell these chemicals under our own De.mem brand. So the customer gets everything out of one go, kind of as a one-stop shop. And for customers in particular in the mining industry, we also offer specialty chemicals on a standalone basis, which includes products like anti-scalants, corrosion inhibitors, which are used for a certain part of the mining and refining process, which is very important for our overall business model as well, because these are really quite attractive business models in terms of margins. The recurring revenue segments, that's finally complemented by our pumps and small water treatment equipment division, because from a sales perspective, that's really what all our industrial customers are asking for. And so our general model is to be that one-stop shop. Moving to the next slide now, with a very strong focus on industrial customers. So typically De.mem stays out of municipal tenders. We really focus on industrial customers, customers where we are able to build like a key account, like a long-term customer relationship, where customers come back to us to reorder things like specialty chemicals, where customers sign long-term contracts such as the BOO or O&M agreements. When looking at our customer base, obviously, as we're at this stage still predominantly in Australia, that would follow to some extent the Australian economy. So we've been working with a lot of the big mining corporations. We've been working with a lot of customers from the food and beverage and agricultural space. Obviously, these are the larger corporates, but we work with a lot of SMEs as well. What's common to our customer base is that almost all of them operate on multiple sites. So a company, and I will come back to that in a minute when it comes to the updates, a company like Givaudan in the F&B segment, which is the worldwide market leader in food ingredients, they actually operate in more than 185 locations all over the planet. And this clearly defines our growth strategy, this land and expand strategy, to move with a customer from one side to the next, which makes it possible to grow De.mem with a very lean sales model and with a limited investment into a sales organization, because we really expand with these existing customer relationships. We are unique through our own IP, which is in our hollow fiber membrane technology. These hollow fiber membranes, we deploy these membrane cartridges as part of our containerized water treatment plants. You can consider them a little bit like the Intel Inside in our products. The membrane comes in hollow fiber format, which is like a straw-shaped format. It's a microporous structure, so you have tiny little pores which are just small enough or big enough so water molecules can pass through. But depending on the pore size, then contaminants, depending on their own size, are filtered out. And on the back of this working principle, over the years, our company has delivered a range of hollow fiber membrane technologies, a whole portfolio of them. Starting with our more established ultrafiltration membrane with a somewhat larger pore size. But then we also offer certain technologies such as the hollow fiber nanofiltration membrane, which comes with a very, very small pore size, which is pretty unique within the water treatment industry. And lastly, and I will come back to that in more detail in just a minute, we also more recently presented our graphene oxide enhanced polymer membrane. That's a hollow fiber membrane based on the polymer standard, which is enhanced by simply adding graphene oxide nanoparticles into it, increases the throughput, increases the efficiency, and substantially decreases the cost of the water filtration process. And as mentioned, so we use these technologies to really give us that competitive edge, that little advantage over our competitors, which other companies can't offer. This takes us to the updates. So the updates are also in some sort of reference to the objectives which we've communicated as part of the capital raise, which our company completed in late July. So one of the objectives was to promote and expand our build on operate segment. So we've delivered against that with that contract award here from Givaudan, the customer I already mentioned, worldwide market leader in the food ingredients space, more than 185 locations all over the world. We actually signed this contract as the fourth major build on operate agreement with that same customer. It comes with 2.1 million Australian dollars in revenues over an initial fixed term of 6 years. And so the product will look a little bit like the sketch there on the left. It's obviously at this stage still in the design stage. Commissioning is expected for about March, April, May next year. And this will treat wastewater from one of the customer Singapore factories to legal discharge standards. So it's basically safe to discharge that treated water into the environment. And on the right of that slide, I've simply listed a few of the key awards that we've received within this build on operate and O&M segment over the last 4 or 5 years, just basically to show that we've continuously delivered new contract awards. It's certainly an important segment for us, and it really cements, it confirms these customer relationships for a very, very long time. The next update is about a project award here, coming back to the more traditional projects type business model from the mining company South32. We announced this project on the 17th October. It's worth about 1.4 million Australian dollars in revenues. Majority of these revenues will be recognized in calendar year 2023. Obviously, the award is still quite recent, so this one is also at the design stage. The final product will look somewhat like these 2 containers there that you can see on that picture on the bottom left. And very important, obviously, around this award is that it's really a door opener for us to get into more business here with that particular mining site from South32. It's a very large Australian mine, and there is obviously a very big opportunity beyond the supply of this system to supply our chemicals, which are used for the operations of that plant, RO, antiscalants, and others. But potentially also to get into the mining business there itself and supply specialty chemicals for the mining operations at that location. Potentially, we can offer operations and maintenance services. And lastly, that plant will require certain consumables, the replacement of filters and membranes, which De.mem can deliver out of its one-stop shop product offering. Coming to the recent developments around our technology and IP, and here taking the example of this graphene oxide enhanced membrane, just to run very briefly through the timeline, as it helps to illustrate how this part of our business works. Obviously, this comes out of Singapore, where we got our membrane R&D and operations. We started working on the R&D for this new technology in 2019. We then presented the new GO-enhanced membrane to the ASX in September 2021. At that stage, validated in the lab and showing pretty interesting characteristics of a higher throughput by a factor of about 20 to 40% relative to the standard polymer membrane, by adding this certain type of GO nanoparticles. And this actually helps to make the technology, well, more efficient in a sense that the same amount of membrane can treat a higher volume of water. But at the same time, the other way around, actually, it's also possible with the same amount of membrane to treat a larger amount of water, which makes the membrane cartridge more compact. It makes the membrane cartridge smaller. And that makes it, from a commercial perspective, pretty attractive for domestic water treatment applications. That's like under the kitchen sink filters where space is limited. That's a fantastic target market for this technology. And so we're pursuing this roadmap further. We initiated a process to obtain NSF approval. The NSF is the American regulator for potable water treatment products. That started in calendar year 2022. In July of the ongoing calendar year, we then announced a partnership with a Canadian company called Purify. And we're now in the final stages of this NSF process, and subject to its completion, then the objective is to launch this technology into the North American market for domestic water treatment jointly with Purify in 2023. One last very quick update, as it basically also completes De.mem delivering against the objectives from the July raise. We announced in early October that we acquired the final 25% in our German subsidiary, De.mem Geotech. We acquired the original 75% in 2019. The business grew nicely by about 78% in Australian dollars, from 1.8 million in 2019 revenues to 3.2 in 2021. So we've seen really strong growth after the initial acquisition. Even in spite of the current situation in Europe around the energy crisis, the business tracks very robust. We reported $205,000 in positive EBITDA for our German operations in the half-year report ended 30th June. We acquired these remaining 25% at, I think, pretty attractive terms that translate into an EBITDA multiple of about 3.5 to 4 times. And so Geotech overall fits very neatly into this track record of 4 pretty successful bolt-on acquisitions, which De.mem completed over the last 4 years, where we acquired small companies with revenues, pre-acquisition revenues of about $1 to $2 million, all of which have grown significantly post the acquisition. This takes me to the financials on the next couple of slides. So from a financial perspective, the key objectives were really over the last 2 or 3 years to grow our recurring revenue segments, because these recurring revenue segments, they come with a higher margin, while at the same time maintaining strict cost discipline, and the ultimate objective, obviously, to improve EBITDA and take the company to EBITDA break even. So starting with the top line, starting with the revenues, I think we've done quite well. We grew the revenues from about 10 million in calendar year 2019 to 18 million in calendar year 2021. We now, with the September quarterly, reported 14 consecutive quarters of growth in cash receipts, and with the 16.2 million in 9 months cash receipts for the period ended 30th September 22, I think we're tracking quite well to keep that growth trend growing. For those of you which have followed our company over a longer term, the December quarter has always been the strongest quarter of our calendar year business. And so we're quite confident that going forward, we will be able to continue strong numbers. Then looking a little bit further down into our P&L, well, recurring revenues, they have indeed been driving the growth of the business. The recurring revenue segments, they've grown much stronger than the projects business, than the overall business, with about 28 to 46% when looking at the forecasted recurring revenues of 17.5 to 20 million for the calendar year 2022. The recurring revenues, they grew in terms of a percentage of overall revenues from 38% in calendar year 2017 to about 90% in the September quarter 2022, as we've reported in that last quarterly. And that's can be clearly seen in the gross margins, then how that has impacted our business. As a result of that recurring revenue growth, our gross margins grew from 19% in calendar year 2017 to about 34% in the 6 months ended June 2022. And that obviously had a massive impact on our overall EBITDA. On the last slide, I was still showing the EBITDA for the last 2 years. So the EBITDA loss in 2019 was minus 3.2 million. That already decreased significantly to minus 2.2 million in calendar year 2021. And in the ongoing calendar year, from quarter to quarter, we've really delivered to that trend. We've significantly improved our quarterly EBITDA loss, started the March quarter with a minus 470,000 EBITDA loss, which decreased to minus 330,000 in the June quarter. And in the September quarter, we've decreased that further to about minus 230,000. Well, so obviously with the ongoing growth, in particular with that growth of our high margin recurring revenue segments, we believe that we are very well positioned to deliver against that key financial objective, which is the quarterly EBITDA and or operating cash flow break even. The timeline for this is that we intend to achieve that by the first half of the upcoming calendar year. And then lastly, with the recent raise, which we completed in late July 2022, we are looking at a cash balance of 5.7 million as of 30th September, which leaves us very well funded to deliver against these objectives. In very short words, that's the final slide of my presentation. To summarize the opportunity around De.mem, we believe that we offer a pretty unique investment proposition and opportunity within this water treatment and ESG environment. Obviously, this opportunity is based on our membrane technology, which is pretty unique within the industry. It's also based on a very unique business and revenue model in a sector which is predominantly projects driven. We have this industrial client focus and that massive share of recurring revenues, which gives our business a lot of stability. And then lastly, we believe it's a good time now to look at De.mem, as obviously, and as I've reported, the company is approaching the financial break even. And that takes me to the end of my presentation, Mark, and I'm very happy to take questions.
Thanks, Andreas. I just want to go back to the build, own, operate, or the operate and maintenance model for the contracts that are announced. When you talk about, it's 1 million over the next 5 years, or that slide there is a good one. Does that include, replacing the membranes and especially chemical sales, or is that portion, going to come on top of what's here? Like let's say if we take, the Rio Tinto one, the 1.7 over 3 million, is that literally just for the actual plant to be built, operated, and then you can get the further sales of the chemicals and the replacement membranes as the contract progresses?
Yeah, it's a bit different from contract to contract, Mark. So for the Rio Tinto one, that's an operations and maintenance contract. That's around the provision of manpower, actually, of water treatment plant operators under the guidance of our engineers. But it excludes the supply of replacement membranes, of small equipment, of the specialty chemicals which are required for the plant operations. So for these operations and maintenance contracts, the actual potential to sell our one-stop shop offering is far bigger than the dollar values reported.
Okay. And the build on operate, does it work the other way? It's a kind of an all-inclusive one-stop shop.
Yeah, it's for each contract, again, depends on the customer negotiations. For the build on operate, it's typically all included because customers, they like to keep things simple. They want to basically make one payment a month, and that's pretty much all they have to do around their water or wastewater treatment. That's the charming part of this business model for customers. But usually what we see is that once we are in a particular site, there is so much demand at a certain factory of the customer for other products that we can offer, such as pumps or other maintenance services or other smaller water treatment equipment that would go into another location of their factory, that these build and operate contracts, they really bring us into customer relationships where there is a huge potential to deliver far more than just the original plant. And
you highlighted, and for somebody who's presented a few times here on Coffee Microcaps, the acquisitions, one of the key parts of that strategy was to get a national footprint across the whole country, which is pretty much there now. So should we kind of expect a period of consolidation now where all these brands are, getting more integrated, cross-selling is happening between customers, and, acquisitions, while I note on the last slide it said opportunistic, but it really would be that, you're not looking for something in Perth to fill a gap, or in Brisbane to fill a gap. It's more about getting all of the brands under the De.mem branding and how best to extract as much synergies and cross sells across all of those acquisitions in recent years. Would that be fair to say?
Yeah, well, for the acquisitions, Mark, the idea was really to take our more sophisticated technologies like the membranes, to take our wider product offering and bring that into existing, customer and sales relationships. Because in an industrial world, in an industrial business, sometimes it can take a little while to basically take the first step to make the first sale with a new customer. And that's what worked out really well for us, as you can see from these numbers in basically all the acquisitions which we made. Now looking at Australia, looking at the product range that we offer, we think the board thinks that De.mem is really well positioned. We've basically got everything covered that we feel is important. But never say never. I mean, it's really opportunistic. At the moment, you can really see attractive opportunities within the market, and where the board and the company feels that it may make sense to accelerate our growth, to bring us still into a new location or so, we might still consider. But that's really what we mean with opportunistic. We're certainly at a point now where we are well covered with offices in Brisbane, in Melbourne, in Launceston, Tasmania, and in Perth. We can deliver to all customers Australia-wide. But as mentioned, never say never, and on an opportunistic basis, we may still consider.
And then one final one. I know you called out the graphene oxide product that's currently in the process of getting regulatory and standard approvals. Is there anything else we should be watching out for, let's say, in the next 12 months or so, that's a bit further back in the R&D pipeline?
Yeah, I think the graphene oxide one, that's really the big one for us to focus on at the moment, and the NSF certification, that's really the big milestone, because that's required for selling this product into the North American market. Around the graphene oxide membrane certification, we will also present like a new suite or a new type of a domestic water treatment device. I think that will be quite interesting to look at as well. And well, beyond that, I think looking at our membrane portfolio, and I got another slide here in the appendix of my presentation, Mark, we cover a pretty wide range of applications in the meantime. So for a company of our size, we're already doing a pretty wide range of things. There will always be improvements coming to our technologies, and to some extent we might present new developments as well. But I think the graphene oxide one, that's really the breakthrough one, well, at this point in time.
Okay, so we'll watch out for that NSF certification, hopefully coming through in 2023 or early 2023. Andreas, we're just up on time, perfectly on time, in fact. Thank you very much for coming back and joining us at this technology conference this morning. And we look forward to hearing from De.mem early in the new year, hopefully.
Thanks a lot, Mark. Appreciate the opportunity. Thank you.
Thank you. And I do know we have Christopher Clark standing by. Chris, if you want to start sharing your presentation now that Andreas has taken down his, I'll let you know.
Sure.
I'll let you know when I can see it coming on. It's just loading now. Yeah, I can see it on the screen now, Chris, so you can take it away.
Perfect. Thank you, Mark, and good morning, everyone. Thanks again for your time and the opportunity. We just
Chris,
released.
Can
yes.
I just interrupt for 1 second? Can you just move a slight bit closer to your microphone, or maybe just turn the volume up at you're just a little bit low?
Not a problem. Stand by. Is this a little bit better?
Only marginally, Chris. That's better. Yeah, there. I think we're good.
Is this better? Should this be okay?
You're very loud now, so maybe we might go back a little bit.
Right. Is this a little bit better?
Now, yeah, I think we've hit the sweet spot now.
Okay, great. Good morning, everyone. Thanks for your time, and thanks, Mark. We're presenting our company today, Delta Drone International. Essentially what Delta Drone is. It's a drone-based data services company. Our business model is to deploy technology, so hardware, software, including people, to mine sites, which capture and digitize mine sites on a daily basis. It's a B2B model with a business formula of long-term renewing contracts, and we're currently out on a bit of a roadshow between Melbourne and Sydney at the moment, so more than welcome for those of you in Sydney. You can come join us at the Technos conference tomorrow. But so a little bit about us and what we do. The company has a relatively small sort of market cap, but in terms of the revenues, last year sort of ending on the 4.6, our half year, which was at the end of June this year, ended up about sort of 2.8. And so if you sort of extrapolate that towards the end of the year, ending at the end of sort of this December, you can really see it's a business that bats well above its weight, or should I say its market cap. We've got a very healthy position of about just over 2 million cash in the bank with no debt, leaving us with an enterprise value of just short of $5 million. And that's really primarily due to a divestment of a tech hardware business, which we did in January this year. And it's really allowed us to focus on building a drone services and tech services business, predominantly, like I say, focus on these primary industries. And we've really, over the last sort of quarter, Mark, we've really managed to capture the essence of the business, which is focused on this annual recurring revenue and total contract value. A lot of sort of people, when they think about drone businesses or drone companies, they think about these very small drones that you sort of buy off the shelves. Us as Delta Drone, we've really taken it, 10 steps further. Our main focus is that we're taking much larger, complex aircraft. We've got very complex sort of approvals from CASA and CAAs around the world to operate these large aircraft on a beyond visual line of sight basis. So this again allows us to capture very large areas very, very quickly and to turn around the data in a very short amount of time, generally even within the same day. And all these sort of data sets that we're outputting is really what the customers want at the end of the day. Customers are not looking to really want to buy or operate drones. They really, what they're looking for is the data outputs that come at the end of it. So looking at the investment, what is the business, where we are today as a company. So we started this business nearly 14 years ago. It started out in Johannesburg and grew up into Africa, into Ghana, and now we've been in Australia for over 2 years. Our primary core of our business has been really about this data capture. So deploying people and the technology to the mine sites and outputting this data, and really focusing on building the efficiencies and economies of scale around that business. So very few businesses can actually build a drone company, a global drone company like what we have done across so many different kind of cultures, and being able to train up all these people in different locations and languages to ensure consistency of the data that's delivered at the end of the day. And our main focus is on these large tier 1, tier 2 customers where we're going to get long-term projects. Saying that, we'll never turn away once-off ad hoc project work, because generally that's where a contract sort of relationship will start, is a customer wanting to test the service out. But we're always looking at solving the piece of the puzzle in the drone data world that is recurring on a high frequency basis. And that's mainly because our biggest competitors are satellite and manned aircraft. Now, satellite, you're sort of finding a frequency of flyovers of a particular area at least once a week, and that's if you're lucky, if the weather holds up, if there's no clouds. Manned aircraft can also really generally be about once a week to once a month, but also can be very expensive. And where drone technology comes into its own is its ability to fly below the clouds and be able to be deployed on a very quick basis. So highly flexible, ready to deploy, and can capture reasonably large areas. Where it obviously falls short is it can't do as wider areas as what manned and satellite can do. But because it's flying lower, you're getting a higher resolution, and you're able to pick up objects as small as a matchbox in comparison to satellite and manned businesses. So all of our customers are a multinational global mining and agriculture business. We have long-term contracts from South Africa all the way up to Ghana, where, for example, like with Newmont, where we're providing surveying data. For Bayer, we're providing agriculture data. So, for example, it's doing a lot of flights to do actual plant counting on their research trial projects. They'll have over sort of 20 trials, which they generally sort of would manually monitor with agronomists, and we'll be using drones that can count every single plant, determine the densities, and essentially output a KPI report to say how that trial is going, and that allows them to turn around products a lot quicker. What's really exciting about our business is our operating metrics and the financials. So our growth has been predominantly out of Africa, and we're very proud that in the last sort of 2 years that now encompasses nearly a third of our revenues generated in Australia, and 40% of this revenue is based on multi-year contracts. So it's a business that's sort of slow and steady wins the race. We get great customers, great projects. We have multi-dimensions to this revenue. So while a lot of it is services based, and drone data. We're also able to sell hardware and conduct training for the customers who don't want to necessarily take on the services. So really multifaceted into our approach in owning this drone market and owning this drone space from a holistic level. Our annual recurring revenues is really what makes this a special value proposition for investors. So we're going out to our customers who need this data. They've got long-term mine lives, which are sort of guaranteed, and we're able to sign up these long-term contracts and really then now start displaying that through our total contract value and our annual recurring revenue metrics. So just recently, we sort of formalized our relationship with Anglo American as well on the Mogalakwena Platinum mine, and that really sort of began as an ad hoc relationship, which then transformed into a long-term relationship. And while a lot of our revenue would encompass this sort of ad hoc revenue, now because we've got a longer-term commitment, we can now include that within our annual recurring revenue and total contract value numbers. So if you're looking at our ARR, at the end of the quarter two, we were just over 2 million. That's obviously really kind of bumped up post-quarter on the Anglo American sort of numbers as well. And really the focus of the business is to use the cash that we received out of the divestment from the business in January to really see us out towards the operating sort of profitability in 23. We're really about focusing the business on the growth side right now. It's we don't have a shortage of opportunities. It's just about which ones do we tackle first and which one will add the most to the bottom line for us as well. Australia is our focus area. This is where we find we get more value for the amount of effort that we put into the new contracts that we sign up. It is a highly competitive market in that the current climate is that major mining operators do it all themselves. So BHP has over 800 trained drone pilots. South 32's done, Rio's done over about 600, South 32, closer to 200. And so there's a massive demand for this data, but really it's about the customers right now have never had an option, an enterprise choice of outsourcing it. And that's what is really makes Delta Drones offering very, very unique. Our quarterly results and the revenue cash receipts, we sort of put all out there as well. So monitoring the cash, like as we mentioned, going forward. Our revenue breakdown, if we sort of look at this interesting hamburger diagram, 40% of the revenue is recurring, 34% is ad hoc revenue on the last quarter. And what's really quite interesting is that sort of in the middle, that 26% paddy over there is revenue, which is customers who've been with us for a very long time, but have not really signed formal long-term contracts. So these are customers we may convert as they see sort of the more the value, but these customers who just continuously keep giving us purchase orders and have been operating with us on a long-term basis, just not yet formalized into a formal deal. So where we're going with the drone industry and as Delta Drone as well, and what is really our strategy and focus. As mentioned, what we've really sort of perfected as Delta Drone over the last decade is our ability to scale up the capture side of the business. And this has been our growth area that a lot of customers have appreciated us sort of solving and offering it at a very highly competitive cost. But we realized that we need to start doing a lot more than only just capturing and producing raw data. And where we're seeing a lot of demand from our customers is how to add value or insights on top of that data, be it through either AI or other geospatial sort of tools and mechanisms. And it's really about producing at the end of the day a PDF report that they can then use to make their decisions. So where originally customers derived a lot of value just from the visuals, which is still always going to be the starting point. It's about how do we quantify the risks or the change in what we're seeing. So we really kind of find ourselves as Delta Drone sort of, I guess, in our index moment. We're really, our goal is to be the near map of the drone world, and how we get there is really start to to start pivoting our front end of our marketing to be a lot more data and product focused. We're sort of in this transition at the moment where we really can produce all of these reports, and this is what we've been doing, over the last 10 years. But customers probably are a little hesitant to the word services because they feel they might feel it's sort of competing with what their role might be in their sort of environment. So we're saying, look, well, what we will do is we'll start offering the data products, and really what we want to sort of play on is the data products that got very high frequency of output. So looking at things like optimizing drill and blasts, where you're flying a drone pre and post every single blast to find that 3 to 4% in savings. And if many of you know, in a mining environment, explosives is the third largest cost on the P&L after load and haul and wages. And so 3 to 4% for these major miners really constitutes over millions or tens of millions of dollars in savings. And that's all triggered by this high frequency drone capture, which allows you to identify the cost saving areas before you even press the button to do the explosives. Drone technology has also got the focus on, again, high changing environments, so infrastructure, construction, and even really important areas such as tailing storage facilities. This is what we do, and being able to monitor and focus on these areas to ensure that they're being monitored on a consistent basis using thermal data, using LiDAR sensors to essentially sort of give the confidence that the products or the environment and the risks are being managed. So what makes us very unique opposed to other sort of drone data companies? I already spoke quite a lot about the data acquisition side and our scalable business model, there are very few companies in the world which are not only just listed, but have actually been able to achieve this on a global scale. But it's also about how we're starting to deploy and use our AI skills. Now, we don't have any platform developers, but we do have application developers in-house, which is able to use off-the-shelf software tools like sort of often AWS or other AI sort of mechanisms to build detectors around, for example, using image recognition sensors. So we've got customers in the audit field who want us to help count sheep, to count cows, and that's really the same detector that counts plants. So any kind of customer wants to fly and do high resolution areas and then be able to identify fauna, flora, and species, and it's essentially produce ecology maps. We've got all these skills and abilities which sort of flow through from not only from the data capture side, but to quantify it and to visually then represent that and put that into a reporting mechanism, which allows our customers to make all these decisions. This is all backed by best in sort of grade survey equipment which we use. So again, not using these small aircraft, but much larger fixed wing, really expensive sort of equipment that we write off, and we deploy it and do it at scale and do it much quicker and faster than the customer could do it themselves. So speaking a little bit about the market locally in Australia as well. So if you're looking at pure drone services, so not the hardware, not the software side, you're looking at just over $500 million in spend per year. And really a lot of that currently is driven out of the mining market. But the big potential here is in the agriculture and construction space. We've got a lot of experience and skills and exposure in these two particular industries, but we obviously will keep our eye open on the construction as well, which would operate more in the urban regions opposed to where we're currently using our larger aircraft, which is opening more in these rural size areas. But where we see the opportunity in agriculture is a lot to link up with and align with precision ag applications. So where we're flying a drone the day before, able to detect weed species, we geolocate or georeference each unit. So it's like giving a GPS coordinate to each weed, which can then plug into sprayers, and they can then only spot spray what they need to do. So you're saving 70 to 90% of your chemicals in a precision ag or drone-based system, opposed to for example, like a John Deere solution, which you pre-mix the entire mixture of chemicals up, and then you start driving and it's got cameras on board the boom, and it only spot sprays what it can see, but then you're left with chemicals, generally 10-20% in the machine afterwards, which go to waste. Whereas opposed to a drone, you're flying the day before, you can really sort of calculate the volume that you only need to mix up, so you're focused on the savings right up front before you go out and spray. Our pathways is all about maintaining our corporate costs while focusing on the customer growth. We got a very strong pipeline, both Australia and Africa. It's just about finding the balance between using the ad hoc work locally in Australia to sort of feed us on a day-to-day basis, but also focusing on those customers which take a slightly longer sales cycle to convert to a contract, understandably. But it's just about taking the customer through those steps and showing them the business value of committing to the long term saves you a lot more money in the future as well. We're not opposed to looking at doing a couple of acquisitions as well, which is sort of in the line of what we do. So very similar, we acquired a business in Perth, of Vista, and in a year's time, we were able to sort of double their revenues through bringing in our new financial and operating model to the business. And if we can do that across the country on other smaller, sort of similar businesses, we definitely look at that as well. And that's all from me, Mark. Thanks to everyone, and thanks for your time and for sharing this moment with us.
Thanks, Chris. I might just get the ball rolling on the questions. One is on the long-term customers who haven't moved to a formalized contract over a longer period of time. What happens there in terms of pricing and margins? Are they just inherently risk adverse to a longer term contract by the very nature of mining being highly variable, and they're happy to pay a premium for the I'm guessing for the month on month, as opposed to taking a bit of a discount, but in lieu of actually having to make a longer term commitment?
Yeah, I think it's a combination of that, Mark, as well as, traditionally our customers locally have sort of been at the middle management level, so they don't necessarily have the authorization to make the longer term commitment. So they can make the short term decisions pretty quickly and give us sort of a once-off project. But what ends up happening is we get that recurring project, for years. And some customers we've had for 2 or 3 years. And I think now eventually, once we sort of propose them, say, look, there is going to be a saving if you take on the longer term commitment. I think then they sort of feel comfortable in converting. So you're still going to find that sort of, like we sort of showed the graph earlier, the sort of that sort of patty in the middle there, where you've got the special selective customers who are sort of in the transition phase, and it is about converting them. They do convert, Mark. They do convert. It just probably just takes a lot longer, and there probably is, like you say, a lot more, some percentage of the market a little bit more risk averse, where some sign up immediately can do it, but I think it's just about being sort of open to the customers and taking the journey with them, and adding more value to the product or the service where it counts to get them across the line.
And then just on the cash flows from the longer term contracts, let's say it's 12 or maybe even 24 months, do the clients typically pay up front annually, or do they pay up front on a monthly basis? So when you announce a new contract, it's 12 months and whatever the number might be, how does that actually reflect itself in a cash flow sequence?
Yeah, so we do put up the cash up front for the capex expenditure, and then we recover that on a monthly basis from the customer over the life of the contract. So they'll sign off the contract. We'll put normal rise and fall provisions within those contracts, and that's generally how we would spread it out.
Okay. And just because you had the kind of halves up there, seasonality in the business, just given both your main markets are kind of in the southern hemisphere, South Africa and Australia. Is there much seasonality in the business? But is half one generally bigger than half two, or how? What can kind of people expect as we go through the next couple of months?
Yeah, so the main reason why we focused on mining is that it's pretty consistent. You're digging, so you're digging rocks out of the ground, and majority of our customers are using their drone data for survey. But the whole idea and intent is that where we're slowly converting more usage of the data is we're already flying, capturing the entire mine site on a daily basis, and we're producing this high resolution data, and the customers at this point are pretty well set up to ingest survey and planning data, and to if and to do sort of reporting on that. But where we're starting to on-sell the same data set is to other departments such as the geotech or the environmental department. So when they're not paying again for the data to be flown twice, but they're able to ingest this sort of digitized version of the mine to make lots of other sort of decisions if they've already got the software set up. If they don't, we can then recommend other software tools or consultants who could then take it that one step further. We also got, like I say, some of our own products, which you see on screen here, that allow us to keep on selling that data, so keep adding more and more value. So the seasonality is not really relevant to the mining context, but highly relevant in the ag side. Generally, there we'll sort of only get a 6-month contract out of a year, understandably, but then customers like Bayer will give us 6 months in South Africa and then 6 months up in Zambia, for instance, on both sides of the equator. So we're slowly mitigating that, but our core business seems to be on the mining, but our new revenues and our higher margins are focused on the ag industry, as well as actually autonomy. We're really focused on bringing out a couple of new products in the new year, focused more around a software platform and autonomous drone solutions that will not only decrease the cost overall from not having a pilot on site, but also allow us to increase our margins as we have to monitor them remotely from our operating centers in Perth and Johannesburg.
And the competitive landscape, if you're pitching to clients, are you coming up against regular competitors, or is the main competitor maybe they've got some kind of internal expertise, while it mightn't be as sophisticated and as rich in data terms? It's kind of getting the job done for them, and they're maybe just a bit reluctant to change.
Correct. Yeah. So so other than our external competitors, which has been predominantly manned aircraft and satellite, we've got a solution around that where we're now going head to head with manned LiDAR solutions, and we're coming in not only cheaper, but we're getting high frequency. So on the manned aircraft LiDAR, for the price that you're paying for, let's say, flying once a week, we're flying every single day. So a lot more data, high frequency, which you can split across multiple departments. On the internal side of competitiveness, it is the customer themselves. As I mentioned, BHP's trained over 800 drone pilots in the operations, but they haven't given them very large, sophisticated piece of equipment. It's generally a lot of this is off the shelf, smaller drones, which, to be honest, it's fine for taking quick photo or video and doing a quick manual inspection. But for doing large scale surveys at a beyond visual line of sight basis, they're not economical, and they just take a very, very long time, multiple setups in a day. And if you think about, you're paying engineers, on BHP sites, anywhere from $140,000 to $180,000 a year. If they're spending half their time out in the sunshine, just taking drone flights, you can see why a lot of people might not want to change, because they think they've got the best job in the world, getting paid those kind of salaries. But that's our value proposition to the customers, and I think it's just about finding the right person on the mine site to say, rather instead of them being out in the sun all day, they could be behind the screen doing the reporting and analysis if necessary, and we can focus on the data acquisition and the initial processing.
And I know you mentioned, it's mining, it's ag, and it's kind of commercial construction, but would there be further applications in the energy space in terms of, big complex things, like Barrow Island, or monitoring pipelines that you're going out of sight that are coming from a particular region? Is that something that could be potentially down the line for Delta Drone?
So we're seeing a very interesting trend coming, especially up in the African market, but more, and we've had 1 or 2 requests in Australia as well, and that's around security and surveillance. So you're finding the need to be monitoring data centers, as you mentioned, Mark, pipelines, removing people from dangerous areas, and it's essentially you're replacing the patrol guard, right? So and how to automate that. So the technology exists. We've already done a proof of concept. We're applying for our approvals at the moment, and it's really about automating the security guard and automating that via a drone in a box solution, which is placed in multiple locations across the site, and during the day it can be used for visual inspection. So you can if you're someone sitting, sort of an executive sitting in Perth, and you want to see what's happening at your mine or your oil and gas site, remotely, you can deploy the drone using looks like a PlayStation game control, and go quickly get a quick visual, live video stream as well. And then at night we can put that onto a scheduled sort of calendar with predetermined flight paths that can use the thermal sensor and do routine security patrols. It's then got an AI overlay so that if it detects a person or vehicle between certain time parameters, it would then trigger the sort of armed response teams to go there. So it's a hell of an exciting space to really be in at the moment, and we're definitely not aborted in what we do.
Okay. Chris, we're going to have to leave it there. We're just up on time, and we'll look forward to hearing more about let's say that industry or product extension, hopefully in 2023.
Perfect, Mark. Thanks for your time, and thanks to everyone.
Thanks, Chris. And I know Jamie is standing by from Bridge. Jamie, if you want to start sharing your screen, I'll let you know when I can see it coming up. Yeah, it's just coming through now. And if you could just make it full screen, it's cutting off on one side, it looks like, or maybe just tab to the next slide, please, Jamie, just to see what it looks like. Jamie, can you hear us?
Yeah, I can hear you now. Yep.
Okay, great. Do you want to, I was just saying there, if you can try and make it full screen mode, it's a little narrow, your presentation or your deck.
Yeah, it says that it's paused sharing, but it's full screen on mine.
Okay, let's just try tab to the next slide just to see what it looks like. I'm presuming it's the disclaimer slide.
Yeah.
Yeah, no, there's nothing happening on our side that I can see.
I'll stop the share and start it again. 1 second.
Okay, no problem.
How's that?
Yeah, much better. Now it's full screen on my side, and just tab to the next slide, please, Jamie. And yeah, the disclaimer slide. Yeah, no, that looks good. I think we're all set now.
Excellent. Okay, great.
Yep, you can take it away, Jamie.
Okay. All right. Morning, everybody. I'm Jamie Conyngham. I'm the CEO of Bridge. We are a software as a service company which provides software to a group of organizations called providers. Now, a provider is a company that provides services on behalf of federal government contracts. So the two main areas that we look at are employment services providers and more recently NDIS providers. So we provide the software to them to help them become more efficient in the management of their organizations. So I'll just take you through some of the features of Bridge and talk about the market and do that for about 20 minutes and then open it up to questions for the last 10 minutes. So just to talk about the opportunity here, what's going on is that with providers, specifically NDIS providers, but also our core, which was employment services providers, there's a lot of red tape. And what that means is like there's a lot of compliance where the government makes the providers do lots of things to get their money from the government. So this compliance takes up a lot of admin time. You know, with a small NDIS provider, for example, this could take up, you know, a day out of their 5-day week, right, on admin. And what I mean by that is doing things for the government to satisfy the government so that you can get your money from the government systems, but also like just general compliance that they, you know, the hoops that you have to go through. But basically, there's a huge opportunity for a software company, hopefully us, to take a lead position in NDIS software, and then followed by that aged care software. So we're talking like about, you know, the government spending 30 billion on each of these programs per year. With NDIS, it's forecast to go up to 50 billion now, which just happened in the next couple of years. So the huge pools of money, and you know, the software is required by these providers to run their organization. So as the amount of money going into this space, like into NDIS and aged care, as the amount of money goes up, then of course, like there's more providers needed to provide the care to disabled people, and you know, like more providers means more opportunity for us to sell into. So a little bit about the company. Established in 2008, we focused on employment services to start with. So employment services providers, what they do is, you know, someone becomes unemployed, they go to Centrelink, and then Centrelink doesn't actually do the work. They send the unemployed person to providers. So you go to Centrelink, and then you're sent to a provider. So we have the operational software for those providers. So we started that off in 2008. And then more recently, the last few years, we've been developing features for NDIS. So it's all the same product, it's all Bridge, but we just make different features for different government programs. So we already have revenue coming from employment services. And yeah, it's a smaller market, but we've been quite successful in that. We still aim to grow that market. It's just that NDIS is a lot bigger. We own all our software, 100% proprietary. We're not running on Salesforce or anything like that. It's been developed over the years. We host a huge amount of data. It's a super secure system run on a defense-grade cloud called Vault. And it's safe to say that our software is already enterprise-grade. So it's not like one of those companies that's got to build everything. Our infrastructure is already done. Some of our providers are already running like 20, 30,000 you know, participants on Bridge. So you can imagine like the size of the databases that we have, like, because we've got like, you know, 20,000 people just with one provider, for example, and all the documentation, or, you know, for each participant, we store all that stuff. So it's a massive amount of data. So what we want to become is like the leading all-in-one software platform for government service providers. So just because we've chosen employment services and now NDIS, it doesn't mean that we're stuck there forever. We want to move into like aged care later, and then potentially, you know, supply Bridge to other providers that we may not have even thought about. But, you know, providers in general can use the core features of Bridge. So we're not just stuck in employment services or NDIS. There's plenty of room to grow. And there's actually, you know, room to grow overseas as well. Some of the investment highlights, as I said, it's 100% owned. IT, so that, you know, there's a fair bit of IP there. The revenue is quite high quality and recurring. So what I mean by that is like we have contracts with these providers, and employment services, where most of our revenue comes from at the moment. Those contracts can be like 2 or 3 years. And we invoice quarterly in advance. So it's quite decent revenue. It's not one of those businesses where you're going out trying to find like new business each month. It's proper recurring multi-year contracts. The addressable market is growing massively. So employment services, there's about 150 providers, but with NDIS there's 17,000 providers. So you can see the scale difference there. So we've already been in employment services. We've still got growth potential there. It's an older market. It's more consolidated. So there's only 150 providers left. But NDIS is at that still early stage, like still 6-7 years old, but we call it early. But it's it's 17,500 providers. A lot of these are small. The other investment highlights is we've got a proven go-to-market strategy. That's before it's fragmented, so there's opportunity for M&A there with our competitors, and we've got quite a good board. We've got the ex-CEO of NDIA just joined, so NDIS is operational arms called NDIA. So we've got Martin Hoffman on there. We've got like Leanne Graham, who was responsible for growing Xero from the beginning. So she grew it from like 100 clients to like 10,000. So and we want to use some of her expertise to help us grow in the same way as Xero did in terms of like the SaaS and their routes to market and that sort of thing. Just quickly on the product stuff. Our solution, the problem first. I've gone into this a little bit, but like it's really complex, like these government funded programs. So we're just taking the complexity out of it. I'll give you some examples on that so you can understand. You can go through this in your own time. But basically, let's take something like, all your participants. You might have like 100 participants. They might be stored in Excel or Word. You can put them all into Bridge. So you can just, quickly get to participants. All the documents are aligned to those participants. So, quickly pull up all the documents related to that participant. But then also, it's the integration from Bridge into these government-funded programs, which means you can do other things like, okay, I don't want to fill out all of these participant details. Let's bring them all in from the government system. So all of the participant information comes across into Bridge, like automatically as it happens. Someone goes to Centrelink, they get sent to a provider, it'll turn up in Bridge straight away, for example. Or you need to claim money back because you've done work for a participant, and through Bridge, it'll just go to the government system and tell them, what work has been done, and the claim will come back into your bank account. So it's these sort of like automations with APIs that we focus on, and just this general, removing these pain points for the providers so that they become more efficient. So what our hope is with NDIS specifically, because they have even less resource, is to just make these providers more efficient by introducing this automation. And by making them more efficient, what that enables the provider to do is to provide more care to the community, which is great for all of us taxpayers. So instead of spending time on admin, they're providing more care. But what it means for them, they spend less time on admin, they can make more revenue themselves as well. And then the bigger picture is that if you can make lots of providers more efficient, like say you make them 20% more efficient, if you've got lots and lots of providers using Bridge, then what happens is the whole of the NDIS becomes more efficient, because you've got the providers being more efficient, so more care is getting to the people. So it has that knock-on effect from a grassroots situation of just helping the provider, which is great for taxpayers, because it's a significant amount of taxpayer money going into NDIS. It's huge, and it's going to be growing almost as big as defence spending, which is massive, right? And so there's a lot of press articles about where's all the money going, what's happening, and so a lot of that inefficiency is created by the bureaucracy, and these providers not being able to provide as much care as they want to, because of this bureaucracy. But you can't really get around it too much. But what we can do is just make the basic things more efficient, like through speed and these APIs and stuff. But the government still has to have checks and balances, otherwise they get scammed. So the core features, I've spoken a bit about this, but there's, as well as client management and APIs, there's things and document management. There's customizable forms, that you can have in there as well, and there's full CRM. We're accredited, which what that means is we're at a level of security that allows us to handle private citizen data on behalf of DEWR, which is the federal government department that runs employment. This sets us apart from other software in the NDIS space as well. Our accreditation is for employment services. It means that we had to go through a whole lot of security, and we have to keep on updating that every 3 years. So, for example, these things are really strict, maybe 800 different security controls, everything from wiping laptops when someone leaves, from not having USB sticks, no printers, all this sort of stuff. As well as all of the back end and front end security around that. So we're very secure, which puts us in a good position for NDIS providers that are worried about security. There's been a lot of hacks lately. One of our competitors got hacked. We use Vault, which is an Australian-owned defence-grade cloud to host all our stuff. So we're in a better position than using AWS or Azure in the sense that our cloud provider is not controlled by an overseas organization like Microsoft or Amazon. So it's just one level of security higher. So that's very important. Just these next 2 slides are just showing you what's happened with the NDIS market and the employment services, the aged care market. So you can see the growth. I mean, it just keeps on growing. So you're talking 30 billion now, going to 50. But aged care is also big. So, people are living longer, all that sort of stuff. That has an impact. Government needs to service it. So 30 billion there as well. So these are very big. Just a little bit about our business model. So we charge per participant. So for example, this is very simplistic. There's other things we charge for, but just as a baseline, you might have 1,000 NDIS participants. We would invoice $5 per participant a month, for example. That would be $5,000 would be the invoice in that situation. We use the same thing in employment services. So the example there, $1,003.30, $3,300 a month. So we find that works because it's like a user pay model. What we want to do is have this very SaaS so that small providers can just go to our website, put in their credit card details, choose their plan, and they start using Bridge straight away. So we want that easy to buy, easy to use, sort of normal SaaS software model for these NDIS providers. The reason we want that is because a lot of these providers in NDIS are small, right? So we're talking like 1 to 10 people. And so what they expect is something that they can just plug and play. They expect to, similar to like Xero, that's what we sort of say, this is like the Xero for NDIS. And what we mean by that is you've got to make it easy. It's got to be intuitive once they open it as well. So it's got to be easy to buy. Go in, choose your package. I've got 50 participants. I'll have that package. Thanks. There's my credit card. Login details come through an email. Bang. It's got to be low touch, so that when they open up Bridge, it has to be very easy to use. It's got to be a lot of the money that we'll be spending from the IPO that we just did a month ago is going into UX and UI. So it's like you hit the claim button to make a claim, things like that. It's got to be very easy, so that just anyone that has little tech experience can just pick it up and start using things, start adding participants, start claiming money. If it's not like that, then users just end up churning, which is no use. So that's a big focus of us. Easy to buy, easy to use, so that we can onboard a lot of these smaller NDIS providers. Domestic expansion strategy. We've already got a foothold in employment services. A lot of the employment services providers are now doing NDIS. So we through Bridge, you're able to run both programs at once. Like, it's just drop down menu, so you can have as many programs as you want. So it's one of our routes. The other route that I'll just touch on quickly is just with NDIS, given they're small providers, you need to be where they are. So Google AdWords, meta marketing, Facebook, that sort of stuff. So we've already tested that market done lots of AdWords as tests. And what we've found is that the market is there and ready. So there's a big, desperate need for software for these small providers. They just don't know what to do. And our competitors haven't really focused on these small ones because they've been focusing on the larger enterprise sort of providers so far. There's quite an immature, fragmented market. So we think there's a big gap there in just getting as many of these smaller NDIS providers as possible, like the SMEs is what we'll be focusing on. So that's our route to market, just traditional digital media. It's an early mover market opportunity for these reasons. On this slide, I just want to talk about one thing that we also have, and that is like we're an NDIS aggregator. And what that means is that for bigger companies that have built their own systems for NDIS, because there's very, very big providers around, some of them don't have like the security clearance to go into NDIS systems, but we do. And so what happens is the NDIS drives these companies that have their own systems, could be Microsoft Dynamics or Salesforce or whatever, to us, and then they piggyback on our security. So they piggyback on our APIs into NDIS. So it's actually another revenue stream beyond the SME providers, which allows us, gives us exposure into the larger providers as well. Organic scaling through the methods that I outlined. So we're going to market, trying to get lots of little providers as well as growing employment services. But there's also an opportunity there to get sales in other countries as well. So that's quite an exciting thing. I'm getting close to the end of it now, but I've got another minute left. I'll just go to the summary slide. So high margin, scalable, proprietary SaaS platform developed over 13 years. We're accredited with the security. Like I said, we've got revenue already. So it's not like one of those startups just going out trying to get revenue, although we want to grow our revenue a lot. But we've got a proven sort of model there, experienced board. It's a very fragmented industry. So there's about 16 competitors at the moment. So we think a number of those, that aren't funded and so forth. There's potential M&A opportunities there. And just to recap there, it's a huge market. So you're talking a 30 billion market and NDIS growing to 50. And when you throw aged care in there as well, it's another 30 billion market. So, these are huge government programs. So I'll open up to Q&A now, Mark.
Thanks, Jamie. Just a quick one for me, just to get the ball rolling. In terms of the competitive landscape, whether it be, if we take employment services first, who do you generally come up against in that market, or who are some of the bigger players that people might be familiar with? And then maybe the same question on NDIS.
Yeah, so in employment services, the biggest competitor we have is a company called ReadyTech. And so they're also listed. So their ticker is RDY. So they compete with us there. They expanded through M&A into other areas like education. So it's really interesting. So they're a great case study to see what you can do with M&A. But they haven't gone into that NDIS health sort of space like us. They went off into education and training and started acquiring companies there. I think they're acquiring like 3 a year at the moment, something like that. They've got PE behind them and stuff. But it's just really interesting to see how they've grown the market cap through acquisition into adjacent verticals. So that's for employment services. With NDIS, the biggest one there is Lumery. I think they're on Series C now. They're focusing a lot on overseas stuff, but that's an example of one that focused on the larger clients, and they haven't got like a SaaS sort of offering like we're suggesting in terms of mopping up a lot of these smaller providers.
And just on the NDIS platform, I mean, is that pretty much built already off the back of the core employment one, and now it's well, I don't want to underestimate the tweaking or customization of it, but is it a case of crafting it in line with what the government wants specifically in that NDIS stream, but the core technology or the core platform is already there, and it's now more customizing it rather than starting to build this from scratch to align with what the government wants?
Yeah, that's actually the beauty of Bridge, right? And that's what I was trying to say before, is that we have these core features that can be applied to any provider. And so, but to give them more functionality, you have to develop other features. So yeah, it's a good way of thinking about it. Like the core features are always there for any provider, but for employment services, we have to continuously build out new features to make their life easier. Same with NDIS. So we've built out a whole lot of features that that match this group called support coordinators. So there's about 6,000 or 7,000 of those in the market. So we're starting off with them, but then there's other ones that we can build other features for, like allied health. There's various other bits of NDIS. So you can keep on developing the product, but we've already started taking the support coordinator one out to market, and so we'll continue to do that. Like just continue to improve the software. Like it's continuous improvement. Software's never finished, sort of thing.
Yeah, and in terms of margins, I know you're only recently IPO'd, so we'll start to see results coming through over the next 12 months. But as we do, if we look at the employment services business, which I'm guessing is going to make up the bulk of the revenues and profits now, should we think of NDIS will operate pretty much on the same level of margins? Once you get a bit of scale going, and then people can just model, based on those rough numbers. Is that fair to say?
No, I think it'll change a bit, right? I'll tell you why. With the NDIS one, it's lighter touch, so your margins are higher. So if you think about, like with employment services, we've got a lot of larger providers there, and we do training for them, and there's continual support, and it's quite and project management with the implementation. They're quite big processes, and the sales cycle's different as well. With proper, like fast SaaS, it's got to be light touch to scale. And so what I mean by that is, like, you've got videos, you've got FAQs, you make it very intuitive, so to try and cut down on support and that sort of thing. And so by doing that, you actually increase your margin, because you're spending less time on training, and which obviously just it's very hard to scale if you're doing face-to-face training for like 1,000 companies, for example, versus if you've got like online self-service type model for 1,000 providers. So that, for that reason, I think it'll be more profitable going forward. But employment services is the core at the moment, so we'll have to wait and see how the scale goes with NDIS. But that's what we're focusing on, is like getting more and more providers in. And
we've seen a lot of chat in the media about the budget for NDIS and how it's increased exponentially. Has that led to inbound inquiry coming into you from people trying to get more efficient, and kind of maybe a bit of pushback from government to say you're operating within NDIS, but we got to try and rein in this cost somehow, and efficiency on providers is one of the ways they're trying to do it?
Yeah, I mean, the interesting thing that's happened, but it wasn't because of the negative press on that. It was because of that hack that I mentioned earlier. Like, one of our competitors got hacked. I think they were using AWS or something like that, but it was in another country. Like their data was in another country. It got downloaded by a technician in India, I think it was, and so all Australian private citizen data that they were running got downloaded by a technician in India and then sold on the dark web, and it was a massive hack, right? Of course, all sorts of issues, and so because of that, NDIS tightened up a bit with their security, and so now they're sending us leads, which is fantastic, because I wasn't expecting that. So they're sending like a group of software providers, where one of them, there's about 6 on the list, leads of companies where they've approached the NDIS to do their own software, and the NDIS has said, nah, you don't have the right security, go through Bridge or one of these other companies. So that's fantastic source for us, which was unexpected.
Okay, great. And typical kind of lead times on to get those NDIS customers, I guess, closed, from kind of initial conversations to onboarding and up and running. I know you said it's much quicker than the employment services, but if we take the Xero example, you can be up and running within 20 minutes. I'm guessing NDIS maybe a bit longer, but if we think
I'm aiming for that same thing, right? Like 20 minutes.
Okay.
Yeah, I'm aiming for that. Like at the moment, our onboarding is really really slow compared to that, like because we've been doing like the larger enterprises. So that was actually part of the use of funds to automate the onboarding in the background. So the DevOps, they call it, but also like the front end, like that ease of buying and that ease of use. They're all the areas that we're focusing on so that we can do that 20-minute thing. But it's not just about getting it in 20 minutes, right? It's like once they've got it, can they use it straight away?
Mm-hmm. Signing up is one thing, but then how actually implementing it and using it on a day-to-day basis from the
are they churning after they buy it? Like,
No, 100%. Let me just check, Jamie. Have we got a question from the audience? We don't currently. Jamie, we're actually just coming up on time. I just noticed here now. Thank you very much for joining us this morning. And hopefully we can get you back in maybe early next year when a few results have come out and we can start to see a bit of traction on the NDIS business and get an update.
Yeah, I'd love to. And thanks for your time and thanks everyone for listening.
Thanks, Jamie. And we are going to move on now to our final presenter. We've got Sharif El-Ansari from Dropsuite. Sharif, if you want to start sharing your presentation.
Sure. Good day, everyone. Thank you for having me. Let me share my presentation. I'm assuming you can see what's being projected as we speak.
I can, Sharif, and just go to there we go. You are looking good. You can take it away.
Thank you so much. Thank you once again for listening, everyone. I'm Sharif El-Ansari. I'm the CEO and Executive Director at Dropsuite. It's a DSE ticker symbol. We've been on the SX for almost 5 years. We are in the backup and data protection business. We've extremely global. We've been building secure and scalable backup technology for mostly businesses, not consumers, SMBs and mid-enterprise. We see ourselves as mission critical for any cyber defense. We see ourselves as the leaders in the industry with getting voted #1 Microsoft 365 backup for 3 years in a row. We're approaching 900,000 paid users across 100 countries, but main focus is on OECD countries. We have more than 80 team members globally, and we have a pure and true revenue recurring, SaaS recurring revenue model. In terms of who we are and what's our mission, we have a very, very simple mission. The mission of this company is to help businesses stay in business, and we do this by protecting some of their most valuable assets. And in this day of age, as we all know, a lot of the company's assets are digital. And the way we do this is, and we do it in a scalable way, is by taking a very partner-centric approach, and we'll cover that in the next few slides, to deliver world-class backup in the cloud for hundreds of thousands of users, as we saw earlier. We work around 3 core principles. We have a team of what we call hungry owners. That means they're hungry, they execute really well, but they don't cut corners, but because we made sure that everybody has long-term incentives in the company, no matter how junior they are, and that are very much interlinked with shareholder value. Second thing here is that we only want to build and sell world-leading products in our target market. So if we cannot lead with a product, then we don't build it. And if we build it and we don't lead, then we kill it. Very simple. And the third key principle or foundation is to make our partners safer and more successful. Let me give you a brief timeline of the company before we talk about the present and the future. So the company was founded in Singapore in 2011. I was the first investor in the company. It was founded by a South African gentleman called John Fearon, operating out of Singapore. The company was founded based on a real life situation where John's previous company got hacked. He lost his customer database and he couldn't really restore his data, his customer data. So he ended up deciding to build a cloud backup companies for small businesses. A couple of years later, after raising some money from VC funds, he asked me to join. That was 9 years ago. And then what we did was very simple. We kept the mission of the company intact, helping business stay in business. We always kept the exceptional user experience, like really easy to use, feature-packed, almost consumer-like, even though we are a B2B company. But the big change that I made in the company was to shift the business model into a partner-first business model. That means selling through partners, because we found that this is a lot more scalable, as we will see, than going and acquiring small businesses one at a time. So our first product was website and database backup. Then we moved into email and Office 365 backup. This is in 2017-18. And we started expanding into a different channel. So the first channel was website hosting, because we're selling a website backup. The second channel that we entered in 2017-18 was what we call the managed service provider channel. And we're going to cover it in the next few slides. And we've been building some award-winning products ever since then. And we've been growing at a very, very fast trajectory. Today, we are ranked #1 in Office 365 backup. We are cash flow positive, we're EBITDA positive. We have a very, very healthy balance sheet with $20 million that was raised last year for M&A. And then we have way surpassed the 20 million ARR psychological mark. And you can see that we've done it in a very efficient way in terms of working capital. So if you look at the 7 million that we raised in Singapore, it was when it was public, when it was private, and then 8 million that we raised in Australia when the company was public, in addition to 20 million. So we're able to get to 24 million ARR with $15 million raised over a period of more than 10 years. And as you can see from the bottom part of the chart, this is the beauty of software, right? You grew your team by 10x, but then you're able to grow revenue by 2,500x. And that's how scalable the business is that we are running today. There's no doubt, and as you heard from the previous presentations, there's quite a bit of tailwinds taking place that are propelling us forward, from cyber threats to increased regulation to the continuous movement to the cloud. Means everything is moving and becoming a SaaS product. All this bodes really well for companies in our industry, and you can see that the market is growing at a really fast pace, 24% CAGR until 2025, and I don't see the market abating anytime soon in the next 5 to 7 years. The other thing to keep in mind is that our core product engine of growth, which is Microsoft 365 and Google Workspace Backup, is, I would say, it is the biggest SaaS product in the world, right? So it's about 350 million users, and we have a tiny, tiny piece of that puzzle. Now, the reason why we have a tiny piece and the market overall is underpenetrated is that many businesses, especially SMBs, still do not have the full security posture, and they don't back up their SaaS applications. And that's why we've been growing at a really, really fast pace. Now, I always make fun of TAM. This is TAM, total addressable market, and I call it theoretical addressable market, because you have to have a specific go-to-market strategy to address this market. So what we've done in Dropsuite is we've been focusing on being partner first and partner-led business. That means we work through various types of partners, especially managed service providers, that we'll cover in a couple of minutes, to grow the business in a highly, highly scalable way with meaningful operational leverage. Now, the good news is that with all the hard work that we've put, and we have about 3,000 of these managed service providers, we are still at only 2% of the market in a universe of 132,000 partners globally. It's really important to focus on what the MSP is. The MSP, managed service provider, is an outsourced IT provider that caters mostly to small and medium businesses to basically be their virtual IT department. It's a massive market. I mean, it's not so far from $1 trillion by 2030. It is growing exponentially faster than the total IT spend of businesses at 4x faster. CAGR is extremely healthy at almost 13%. And as I mentioned earlier, there's about 130,000 MSPs globally in OECD countries, and that is a very conservative count. Other companies or other research firms say it's about 150,000. Now, what's driving this segment or this channel growth? It is the need of companies for operational efficiency, the crazy growth in cybersecurity and regulation risk, the migration to the cloud, and the increasing IT complexity with all of the above. Now, how does Dropsuite cater to these emerging trends, right? So cybersecurity, when you think about backup, backup is the ultimate last resort when it comes to data protection, right? So sometimes you've got issues with employees making mistakes. Sometimes you don't have the most up-to-date version of your security or your operating system software. Number three, there's always an arms race between the bad guys and the good guys, the hackers and the cybersecurity software companies. Sometimes the bad guys win and they're able to find ways around cybersecurity software. So nothing beats backup in being the last and ultimate resort of data protection. So that's number one. Number two, a really interesting and new trend is that cyber insurance qualification is becoming very strict, and there's a lot more insistence and rigor on the security posture, and backup is increasingly becoming a prerequisite to obtain cyber insurance. Obviously, when we work with partners, revenue and margin is a key component of how we incentivize the channel, and backup has become an integral component of the security stack that is being sold to the end users. We talked about regulation and compliance and how with our compliance and archiving module, which is integrated into our product, we're able to provide quite a bit of value to our MSP partners. And then there's an increasing strain to hire IT professionals everywhere. At the same time, MSPs are stuck with very stringent SLA requirements and expectations by the end users and client. What we deliver in Dropsuite is a one-stop solution for all the email and productivity needs that is fully integrated into the MSP's ERPs and workflows. What we've done in the last 5 years is we've delivered the seamless partner experience that we talked about, how we integrate seamlessly into the ERPs of these MSPs and into the workflows. We've delivered almost a consumer-like user experience, which continue to get a lot of accolades and a lot of review awards. We've built our competency in the cloud since 2011. So we've been using Amazon Web Services for more than 10 years. And we believe that cloud operations is a competency for us. We are operating in 14 data centers globally. We are indexing, searching, and backing up more than 50 billion objects. And that's obviously growing. And we built a phenomenal culture in the company, right? High level of accountability, high level of dependability, teamwork, and collaboration. And that's something that I think is a competitive advantage. If you think about what's happening with the Great Resignation, we have very low regretted churn in the company, and we're able to attract some phenomenal talent in the last couple of years. The one thing to keep in mind is that given the size of the market, we talked about 350 million users, there are about 35 credible vendors offering Office 365 backup. Remember, they're catering to 350 million users and growing. But then if you start looking into how we differentiate as a company, you say, okay, of the 35, how many are offering partner-specific programs and integrations? And the number goes from 35 to 11. If you see how many of those vendors are offering the increasingly important Microsoft Teams backup, and you see the number declining from 11 to 6. And then if you see who's also combining Office 365 backup with Google Workspace, the number drops to 3. If you look at how many of these vendors are offering the government data centers. So in the US, you have to be in a specific government cloud that is approved by the federal government. And that's not only for the government itself, but also for any vendor. And there are tens of thousands of vendors working with the US government, and you're down to 2 vendors. And then when you look at what we do differently on top of all this is that we're combining backup with archiving and compliance. That means we are providing tools for HR managers, for compliance managers, for lawyers to sift through the data in case of a lawsuit, in case of a regulatory inquiry. And that's something that truly differentiates us in the market that we serve. In summary, what we've done is we've delivered all this in one solution across any platform for email and productivity, any geography that we serve with 14 data centers. We can cater to a company of 1. We are also catering to a company of 5,000 or 6,000, and we cover and cater various verticals like healthcare, finance, and government. All this solid execution, you've got tailwinds that are definitely propelling forward, has helped us deliver some very strong operational and financial metrics. Annual recurring revenue, and this is, again, let me repeat, truly recurring revenue is up 63% year on year at 23 million. We're approaching 900,000 paying users. Our average revenue per user, because we're selling more of the higher end SKUs, the ones that include compliance and archiving, has been growing. Our number of partners has been growing. Keep in mind, we are counting here the partners who have a contract with us directly and we're billing them directly. There are, as I mentioned, about almost 3,000 partners who are buying our products, and mostly they are small partners who are buying our products from our wholesaler or distribution partners. Our revenue churn on a partner level is extremely low at sub 3% per year. And gross margin has continued to improve over time, and now we're at 66%. Now, one thing to note here is that our gross margin is slightly or about 10 percentage points lower than a typical SaaS company. Now, the reason for that is that what we're doing is that we are sacrificing part of our gross margin in terms of discounts to our partners. In return, we're getting some phenomenal operational leverage on the operating expenditures. I mean, just to give you a case in point, because our partners are taking care of billing and support to the end clients, we have only 6 full-time support people in the company servicing almost 900,000 paying users. In terms of cash flow, we continue improving our cash receipts. You can see our cash receipts improving by 81%. Definitely growing because we are growing as a company, our revenue is growing, but also we've been helped with the appreciation of the US dollar versus the EUD. Keep in mind that 65% of our business is in North America or in the Americas overall. We're cash flow positive, and we have a very meaningful amount of cash at hand. A big part of it is earmarked for acquisitions, not to go back to a cash burn situation. This is how our quarter on quarter cash flow looks like. You can see that we are on a really solid trajectory. Now, that said, it's really important to keep in mind our investment framework. We want to continue growing our annualized recurring revenue at a very healthy rate. We want to generate profit, and given all the tailwinds, our product leadership, our growing partner network, and the size of the market, we want to reinvest that growth for growth and then generate incremental annualized recurring revenue. What does this mean? This means that we intend to stay cash flow positive, but not to necessarily increase the amount of cash that we're generating, keeping it healthy positive, but to then reinvest back in terms of sales, expansion of sales teams, marketing teams, engineering and product, to name a few areas of reinvestment. The way we look at our business and our growth, it's made of 3 components. The most important one is our existing business still has a long way to go in terms of growth. We're introducing new products, so we are today in a closed beta for another backup product, SaaS backup product that will announce to the market in the coming few weeks. And we're obviously looking for high conviction accretive acquisitions so we can continue growing at a much faster rate than the overall industry. In summary, we are blessed to be operating in an environment of strong market tailwinds. We're leading a position in a product that's growing much faster than the market. We built an amazing culture. We continue advancing our M&A opportunities, but again, looking for high conviction. We continue to anticipate high annualized recurring growth, and we've given guidance, high-level guidance to the market, that we will be cash flow positive and profitable for the fiscal year 2022, which in our case is also calendar. So our fiscal year ends in December this year, which is next month. With that, I thank you for listening, and I'll be happy to answer any of your questions.
Thanks, Sharif. I just wanted to touch on something you said there, just on the currency, because I've seen a lot of reports from the big S&P 500 guys saying that the strong dollar was actually affecting some of their overseas sales. You know, when people start translating it into the local currencies. And you said, you know, 65% of yours is US based. But have you seen our partners fed back anything that, you know, people are maybe downgrading or dropping a module here or there as, you know, this strong dollar persists and, you know, their bills are falling due now in local currencies? Has that been any feedback you've got?
Yes, so far we've been doing quite well on this front. So even though we said 65% is in the Americas, but actually our billing in US dollar is probably more like 75%. So even for partners who are outside of the US, because backup is increasingly becoming a table stake item. So far, we haven't seen that weakness.
Okay, and then I just want to touch on you know, gross margins now at 66%, and you said that's, you know, a bit below what you would get in a
typical SaaS.
A typical SaaS, but for various reasons which you've explained. But I'm just wondering, do you think you can crack that 70% level as time goes on and volumes get bigger, or should we kind of steady state think, you know, 66% is going to be kind of normal for Dropsuite, but just multiply it by much bigger volumes?
Yeah, I mean, I would say, you know, for any simulation purposes, I would say keep it steady state at the current rate, while we increasingly get more operating leverage on the OpEx side.
Okay. One from the audience here, Sharif, on the new product you recently launched in private beta, what percentage of your existing customers do you think it'll be relevant to?
It's important to differentiate the customers and partners. So we look at Dropsuite, we look at the partner as being the customer. And I would say that the reason that this specific new product was prioritized is because it fits very well with the partner ecosystem that we're serving. So one of the key criteria when we look at introducing new products is how well it fits into our existing channel. And this one fits like a glove.
Okay. And then just on the acquisitions or the M&A, is the thinking there to, you know, you said most of your partners are in that OECD market space. Is it looking to, you know, buy a kind of an entry into more of a big emerging market or emerging markets more broadly, or is it more kind of a thinking of buying you know, products that would fit very nicely with your partner network, but it's kind of the old develop it yourself versus speed of purchasing, and you can take an existing product and push it through a much bigger partner network that you have, that maybe the company you're looking at just doesn't have that length of and breadth relationships?
Yeah, exactly. So first of all, I see us continuously focusing on OECD countries for the next couple of years. We still have a long way to go in terms of white space, right? Number two, much higher IT maturity, and number three, higher propensity to spend money on security and backup solutions. When it comes to M&A, we're looking at companies in OECD countries, or at least having their core market being in OECD countries. We're looking at companies who are either slightly cash flow positive or slightly cash flow negative, but they don't have the financial muscle, or in fact, the channel muscle to extend their product and grow it at a very fast pace. So we're looking at highly complementary data protection products that we can integrate into our partner portal, our partners' workflows, and then easily cross-sell and increase the share of wallet with our existing and growing partner base.
Okay, another question from the audience, Sharif. How often would an end user restore something from backups on average?
That actually the majority of the restores or downloads or searches that are taking place are actually being done by the partner on behalf of the end user. So the way it works is that the end user would log a support ticket, and basically they will get a white glove treatment from the MSP as if they are, as the outsourced IT department. We get quite significant amount of restores and downloads every month. So it's about 1 to 1.2% of the total number of companies end up restoring or downloading every month. So if you compound it over about a year, you're talking about 13-14% of our users through the partners are downloading or restoring data from our systems.
Yeah, that's quite a lot. It's a lot higher than I would have guessed myself.
Yeah, so surprisingly, it's quite high. Now, keep in mind that it's also, as I mentioned, there's also the compliance module as well. So it could be, it doesn't have to be restoring lost data for a ransomware event or a lost file or a lost email. It could also be the compliance officer or lawyer sifting through the data for a lawsuit or for an audit or something like that as well.
Okay. And you mentioned, it's getting much harder to get cyber insurance. And I mean, we've seen major data breaches in Australia with a couple of big high profile names in the last month or two. Is that trend pretty much a global trend where the insurance providers are pushing back now and saying if you really need XYZ to be in place before they'll even think about coverage, and even if you want a really high level of coverage, you're going to have to have even more than what you maybe might have had 12 months ago?
Yeah, we're seeing quote unquote green shoots of that in the US for sure.
Okay.
And usually, as you probably know, things start in the US and then they trickle down to the rest of the world. We are seeing some specific partners explaining that we need this because we need to ensure our client qualifies. And sometimes the MSP themselves, the partner, also need to qualify for their own version of cyber insurance as well. So I say these are the green shoots of that trend. I believe two trends are going to continue giving us additional tailwinds. One is cyber insurance. The second one is, and just look at what happened in Australia recently in the last few weeks. You've got some what Australian government calls SONs, systems of national significance, like telcos, major hospitals, etc., banks, that are getting hacked and being affected. I expect more regulation, not just on data privacy, which has been with us since 2018, but also on the security posture of these companies. It's going to be almost regulated, and it starts with the enterprise, with the big companies, and it slowly trickles down to the mid-enterprise and to the SMBs.
And I mean, in the Australian market, when you see these major data breaches and it's all over the media, do you find that drives a review or an uptick, or just a more general awareness from the SME market that they need to relook at what they have in place, or even get something in place if they have nothing in place, or is it not really?
We see more push. Yeah, we see more push from so our partners. We use this information to put the message across more strongly to the SMBs who sometimes take their time to increase their budget. So that's where we see the impact. The impact comes from existing or new managed service providers are able to increase the number of users that are using backup after such events. We saw, for example, a big push. Now remember, you're talking about Australia. The one that really was very, very visible, and we felt the impact of it, was when the US Treasury Department, along with SolarWinds, were hacked. So every time there's a major event, there is some ensuing demand that comes after it because of the increased awareness. But it's not like a flood or a tsunami of demand, to be clear.
But it's an incremental response, and yeah, the more high profile ones, I think the better for you.
Correct.
And then final, I'll take what we've got one more question from the audience, and I think we might just leave it there then. On reinvesting cash flows back into sales, marketing, and tech development, what would you get from the increased level, or what are you kind of expecting from this increased level of investments across those kind of three parts of the business?
Yeah, I mean, one thing to keep in mind when we talked about partners, we still have like a tiny 2% share of a conservative count of the total MSPs in OECD countries, right? So 3,000 out of north of 130,000. And then when you look at the addressable market of our existing product, which is Office 365, the one that we can service, right? Not the theoretical addressable market. There's still a lot of opportunities. And then you look at new products, and then then we can increase our share of wallet and ARPU and possibly gross margin if we get some good volume. So what we're doing basically is ensuring we have enough building blocks for 2023 and beyond to continue on a meaningful growth premium versus the market. So if the market is growing at 20-24%, we want to grow at double that for the foreseeable future. The only way to fight the law of big numbers is by continuously investing, prudently, but investing in these building blocks. So for example, I'll give you a couple of examples of things that we've done today. We onboarded a phenomenal head of channel for Australia and New Zealand. So historically, we didn't even have one person in Australia. So we're building a small team in Australia because we feel Australia, New Zealand, and by extension, the rest of Asia Pacific is a very interesting market for us to grow. Right now, it's only 12-13% of the total revenue for the company. We just onboarded, again, another fantastic leader to lead globally the MSP channel, somebody who's an industry veteran, who's worked in Microsoft with distribution and MSPs, who can take the company to the next level. On the engineering side, we're introducing additional security measures, because if you look at our risk register, the number one risk on our register is us getting a data breach. So further solidifying our security posture is absolutely critical. That's a third flavor of investment. We're introducing new sales roles in North America and EMEA in the coming few months, because our team is not able to keep up, or is barely able to keep up with demand. So adding more sales and customer success people is really critical, not only to successfully onboard the partner, but also to ensure that we are mutually successful in the relationship. So we're segregating the two roles. The person who works and onboards the partner will be with the partner for a few months, but then they will hand over this to a customer success or a partner success person who's responsible to ensure that we increase the number of licenses. We are making sure we're fielding feedback. We're keeping them informed about our roadmap and all the good things that come with having somebody with you on the journey.
Okay, got it. Sharif, we're going to leave it there because we're just slightly over time, but we're fine.
Sure. My email is here. I listened to your instructions and I put my email here. I tend to be responsive to email, so if any questions, just email me. I tend to respond within a couple of days at the most.
Okay, perfect. And thank you very much for that. And I just want to finish off by saying this was day one of our technology conference. We have day two starting tomorrow morning at 9:30 as tomorrow's starting at 9. Unfortunately, John Thompson from Gnosis won't be able to join us this morning. Something has come up at last minute on his side, so we slightly later start tomorrow. We're going to start with Jared Dyson, who's actually dialing in from the US from Spectre, is going to be our first presenter tomorrow morning. But thanks to Sharif and everyone who tuned in this morning, and I look forward to seeing hopefully some of you for day two tomorrow.